powerhouse. And so, of course, relevant to the topic today, we got to have energy. We got to have energy to fuel all of the growing technology and digital infrastructure that we need to make sure that in places like AI, blockchain, crypto, all of these different areas, we have the basic infrastructure and energy to be able to fuel the innovation in this space. And so I do a lot of things in this area. I sit on the Energy and Commerce Committee. 14 years since a freshman has actually gotten a seat on the Energy and Commerce Committee. But it's because my district is such an energy powerhouse. And so from making more American energy to strengthening and expanding the capacity of the grid to having conversations around permitting reform so that we make it easier for some of the large users of energy to be able to get access to that energy without passing on costs to ratepayers. Those are all of the things that I work on to just build the foundation so we have a good environment for Bitcoin and blockchain and crypto and all of the other areas to grow.
Yeah, and I know you have a pretty interesting background on the national security or defense side as well. I want to get into that. But on energy, I know a big topic of conversation a few years ago was how much mining could consume. And now it seems like data centers are playing a big part in that. Do you see AI and crypto kind of converging on the energy use space, or like what's important to you and your constituents about seeing responsible innovation in that space going forward?
Yeah, so the big concerns for my constituents really boil down to two things: the environmental impacts of digital infrastructure like data centers, and then of course the cost. But the good news is, done correctly, AI, digital infrastructure, data centers, you can actually use those to bring down costs for ratepayers. I always explain that the cost that you pay for your electricity is based on peak demand, so think a bell curve. What data centers can do, because they need the digital infrastructure, they need the energy, they're willing to pay a ton of money to strengthen the grid, expand the grid, pay for more generation, but they can also throttle back their usage at peak demand. And so what that does, that actually flattens out that curve. You're going to see rate reductions announced throughout the Midwest, and that's actually a result of partnering with some of these big users like data centers, because when you flatten out that curve, you actually lower the cost of electricity while gaining the benefit of all of that new infrastructure that the data center or the AI company or somebody else paid for. And so that just has a ton of benefits done correctly in terms of not only the economy and lower rates, but again, national security, because like I tell everybody, crypto, blockchain, AI, those things aren't going away. The only question is, does the United States lead, or do we allow communist China to become the global standard and the global leaders in those spaces? And if China is the global leader in all of those things, that's just bad for humanity in general.
Yeah, let's talk about that from a national security perspective a little bit. I'd love if you could tell the audience a bit more about your experience there. I know you were a Black Hawk helicopter pilot, big focus on that, and it seems like illicit finance and national security have become big topics in this space, especially as we try to push clarity forward. So what are your thoughts on the sort of defense and national security aspect?
Yeah, absolutely. So this is one of those areas where my office has specifically engaged on this issue, being a millennial, so somebody that understands technology, wanting to see this grow, being a small government conservative, wanting to make sure that we have common sense regulations and guardrails, but we have the lightest touch possible so that industry has the greatest opportunity to grow and to innovate, and we bring these jobs and we protect these jobs and this sector here in the United States. So really in that whole space, that's where my office is engaged. I can work with law enforcement and their financial crimes investigators if they have concerns that some of these technologies may be used for moving drug money around or for human trafficking. I can convene that discussion group between your law enforcement financial investigators, your folks that are tracking terrorist financial transactions, and sit down and work with the blockchain community, work with the crypto community to figure out how do we work together, because we all want the same thing. How do we work together to build common sense legislation around this that both keeps Americans safe, keeps our communities safe, gives our law enforcement and our counter-terrorist operators the tools that they need, while again allowing the industry the ability to grow and flourish here in the United States.
Yeah, let's talk about where we are with clarity and developer protection, because it seems like the law enforcement community has maybe split on the issue or has come out kind of for or against whether or not there's enough illicit finance protection built into the bill right now. Just given your background and what you were just talking about, like, where do you think we're landing on the conversation around developer protection? And then a lot of the industry is talking about how there's so much consumer protection built into this bill. Where do you think we're going to end up on developer protections and the safeguards that we need for illicit finance?
A lot of that just boils down to the definition, because in the old days you had people that like coded, and then you had people that used. And those two roles are so blended together right now. I mean, so one of my kids' favorite movies is Tron. And even in Tron, like, they talk about users, but that's not where technology is right now. Whether you're using AI, whether you're using some of these other technologies, creating, using, being a consumer, like, you can cover all of those roles at once in one application. And so a lot of it is just updating our definitions to reflect the way technology actually operates today. And you don't have those neat, clean silos anymore of developers and users and consumers. They're all together, they're all blended together. And so just really having those conversations with subject matter experts that do, financial investigations, and making sure that those definitions are being updated in conjunction with how industry is actually doing things now.
Yeah, and on that notion of whether or not we have the right tools or the right resources in place, I know that's been a big focus of the bill. We've talked about in the past on the show, like folks like TRM Labs, Chainalysis, a lot of those other service providers. Do you think those tools are sufficient? Because one of the funniest things to me about this industry is that it's a blessing and a curse of how transparent it is, right? Like, any data you want, you can go find.
Yeah.
And so are there sufficient tools in place right now for law enforcement agencies to go after the bad actors, to protect both the innovators and the consumers? What do you think about that?
A lot of that actually then boils down to court rulings, because we all know three branches of government, right? Congress makes the laws, the executive enforces the laws, and then the judiciary interprets the laws. And so what law enforcement is allowed to do oftentimes goes back to what have the courts ruled they're allowed to do, what is subject to, say, a warrant request. Versus, as you just said, this technology is both very robust, but it's very transparent. And so just being able to have those conversations with law enforcement stakeholders, and then honestly with trying to get clues about how the courts may view things, and what sort of specific definitions need to be placed in the legislation itself, so that you don't have to then go after the fact to go get a court ruling. Those are the conversations that are happening right now. And so again, just as this, as technology moves at an ever increasing rate, it's why these conversations are so important, so that, again, your financial services investigator can explain what clarity they need to be able to do an investigation. And is that something that needs to be written into law? Is that something that just industry needs to understand? Or is that something where potentially, and ultimately the courts may weigh in on something?
Yeah, I know we've talked a lot about, we're sitting here in DC. It's mid-July. We've got the legislative calendar in front of us, and I know we've said this before, timing is not on our side. In terms of where we are with getting the bill passed, obviously we needed to get out of the Senate, needs to get over to the House. What do you think about sort of where we are in the calendar right now for this bill? And then I'd love to talk about what happens in terms of innovation and sort of responsible technology in the industry if we don't get this done.
I think we'll get it done. We heard some comments earlier. You've got some retiring senators that are very, very invested in this, and so I think then you have that personal investment from senators that want to get this over the finish line before they retire here in 6 months. And so I think that bodes well. The conversations that I'm hearing, of course, not being a senator, but the conversations I'm hearing are that they are close to a deal, and that's the big sticking point. If the Senate can get it done, we can get it done in the House. And so I'm confident that we'll get there. In the unlikely event it doesn't happen, I think that we're just going to, of course, continue to have these conversations, because at the end of the day, it's us or China. Yeah. If we don't have the appropriate regulatory framework where people know that the good actors are going to be rewarded, there's going to be accountability for negative actors, but that we have that system for this industry to grow. If we don't have that here, it's going to go somewhere else. And so I think that is a driving force that cuts across parties, that cuts across chambers. And again, I think that's why we get it done this year.
Absolutely. Well, optimistic take here at the Injective Summit. Thank you so much, Congressman, for sitting down with me.
Yeah, happy to.
Yeah, thank you.
Yeah, thanks for taking some time.
Thanks.
I am excited to be here today with Eric Chen, the CEO of the Injective Foundation. We are at the Injective Policy Summit, so thank you for having us, and also thank you for sitting down with me today.
Thank you so much.
Yeah, I mean, as policymakers, institutions, and builders come together at today's summit, you are at the center of this conversation around how blockchain infrastructure can support, the next generation of global finance, on-chain finance. And the summit has brought together a lot of policymakers alongside crypto builders. So I guess at a high level, why was it so important to Injective to create a forum where these two groups are having direct conversations, and especially today?
I think, the time has really come for us to work directly with regulators, especially, with at the cusp of so many groundbreaking regulations coming about and being devised by, all the regulators and policymakers. This is, the perfect storm to, engage with all these folks to, educate them to come up with the best policy for the industry to move forward. Because I think, historically, we've always been in the process of, working around or working with the existing regulatory framework, and it's been predominantly an industry consensus that the legacy framework simply doesn't work, and this is the first time where we get to engage with all these policymakers to come up with amazing framework that makes everything work for the next stage of the financial evolution.
Yeah, I mean, we've been spending a lot of time talking about blockchain's potential. I know you have for years too. So what do you think needs to happen from a policy perspective to finally move from this experimentative phase to real finance infrastructure?
I think honestly it's just about having clarity, having a set of rules that's industry participants, everyone can work around, everyone can rally behind, and that kind of gives you a very, very clear pathway, even if it means adds a marginal friction into the way of doing business. But it basically gives you clarity on how you should go about engaging with customers in the U.S. And by extension customers globally, and it's really a stepping stone for you to have kind of certainty about basically obtaining all the licenses, obtaining all the process to do so and do everything in an extremely compliant way.
Where do you see Injective sitting within that sphere then?
My vision and my hope is that Injective becomes the very first kind of recognized and compliant chain that can ship a lot of different products, different tokenized assets, and different types of innovative financial products like RWA perps, etc. Because we've done so in the past with IaaS, et cetera. And I think, with more and more clarity, that's just going to give us a lot more certainty about how we're going to go about launching, even more groundbreaking stuff.
Yeah, I mean, and also at this conference, I was speaking with some institutional investors today, some asset management firms, banks, et cetera. They're all in this room, right? So it's very clear, and I heard your speech this morning about this too, is that the institutions are here. But then there's probably still a TAM that isn't, right? So what would you say is the hurdle right now for full institutional adoption of blockchain technology, tokenized assets, the whole gamut of these things?
Yeah, I think, and this is where regulatory clarity and also a very, very well-defined framework comes in, is that a lot of these large, massive institutions, they want to see products being offered, or assets that are being offered that are completely compliant and honestly stands a test of time throughout hundreds and hundreds of years. So what this requires is not some framework that are devised by lawyers based on some kind of theoretical or some a speculation on how the enforcement of these legacy framework will look like, but rather a radical new framework based on the Clarity Act or a stablecoin bill, etc., that can add a very, very well-defined line, and that will actually give you or give the institutions the level of certainty. Is hey, these are products that are completely compliant. It stands the test of time. It's devised alongside policymakers, so it makes sense for us to move forward with size.
Yeah, and I mean, we're sitting here in DC. This is not a fake backdrop. It is actually this beautiful, and it's very obvious in the conversations we're having today that Washington has become noticeably more engaged with crypto over the past year. We had Genius pass about a year ago, and we're in the phases, hopefully, with clarity. But are you seeing kind of a shift in how policymakers understand decentralized finance, or are there still kind of misconceptions there with the conversations you're having, and then also with the Injective Policy Summit, or the Injective Policy Institute? Yeah.
I think it's about like continuous education. They've first
Yeah.
understood how blockchain works, how the asset class works, how the entire world of crypto, along with its assets, kind of engage with the consumers and the investor base. And now it's time to dive into more the DeFi primitives, the different types of on-chain financial infrastructures, and then adding clarity
Of course,
on
yeah.
that, and then the continuous education to follow along with the evolution of these products.
Yeah. I mean, and one of Injective's core theses is to bring financial markets on chain. What piece of today's market infrastructure do you believe is most likely to migrate there first?
I mean, I hate to kind of like beat a dead horse, but I think equity is coming on chain.
Right.
It's the most no-brainer things when the whole like Robinhood saga first came about with GameStop. It kind of like gave out everyone kind of like a awakening moment for them to see the value of tokenized equities, tokenized stocks, and how important it is to have a trustworthy underlying financial infrastructure that's a lot more efficient.
Yeah.
And you see Robinhood kind of like ushering that because in a sense they learned from their mistake in the past and they're trying to bring forth a new infrastructure. And I think that is like the most that's the clearest possible way to demonstrate that there is indeed value and demand for it.
So do you ultimately see all equities coming on chain then?
Absolutely.
Okay, that's fair. By when?
I
like
think,
time frames, yeah.
Yeah, I think time will tell. I think
Yeah.
first of all, there's going to be kind of like representation of these type of equities. It's like a trial period because the underlying stock certificate and also the clearing houses and the settlement process within the kind of traditional financial infrastructure is very, very slow moving. So what you're going to need is kind of like the suction of these assets suddenly being wrapped under like tokenized stocks, suddenly have a lot of demand, seeing just the promise of composability, being able to borrow against it, being able to trade with it with dev, and then they're going to realize it's like, hey, like there's a middleman. Like why are we like wrapping these stocks instead of just addressing it from the bottom up?
Yeah.
And before you know it, everything moves on chain. So I think the proliferation of which is going to happen within the next year or two, and then the fundamental change can happen within the next 5 years.
Yeah, okay, so last question, Eric. Looking ahead over, let's say, the next 12 months, time moves fast in this space. If Congress delivers meaningful market structure legislation, what changes operationally for Injective, the builders within Injective, and then like the bringing on-chain finance to more of a global market?
I think first of all, it's very likely that depending on how the bill comes out, Injective Chain might undergo like an upgrade of the existing modules, especially with the RWA modules, to make sure it's the very first chain that's canonically like compatible with the latest regulation to be one of the first chains to do it. And then on top of that, the proliferation of asset that comes with it, because now there's investor confidence, there's user confidence, then it's a no-brainer for us to kind of go full force. And with a lot of different vibrant builder ecosystem that are bringing so many very interesting product market fit and bring it to the broad user base, I think the distribution channel is just going to exponentially expand.
Amazing. Well, Eric, thank you so much for sitting down with me, and thank you again for having us at your event.
Thank you.
Yeah.
Appreciate it.
Cool. Thank you. Oh my gosh, sorry, I could not. Every time the sun got too powerful, I had to look this way because it's so strong. But I did it for you, okay?
We're ready for the next session, which is going to look at the crypto markets encroachment and infiltration into public markets. So think crypto companies IPOing, SPACing, de-SPACing, of course, debts. The Cambrian explosion that happened last year and then blew up spectacularly this year, I'm sure will also be unpacked. And we'll bring on Connor Emmons, head of institutions at Injective, to spearhead and serve as our vanguard of this conversation. I'll let you take it away, sir.
Thank you, Fred.
Good luck.
Those tunes were nice.
Thank you.
Let's do this thing, guys. Alrighty, well, we are very excited to kick off the next segment here before lunch. We won't keep you too long, but I'm Cooper, as Frank noted. I'll be your moderator. And before hopping into things here, would love to give everybody the opportunity to introduce themselves. And Sochil, would love to start here down with you.
Sure. Hi, everyone. My name is Sochil Ivory. I work at Anchorage Digital. We are a federally chartered bank, crypto bank. We've been having that for 5 years. And I'm on the institutional team, institutional director, and oversee sales for VCs and investors.
I'm Stephen McClure, the CEO of Canary Capital. We are a hedge fund that also has a ETF business focusing on primarily altcoins that have some kind of tokenization feature.
I'm Joseph Shalom. I'm the CEO of SharpLink. SharpLink is a digital asset treasury company and the second largest owner publicly of ETH, the token that secures Ethereum. Before that, I spent 20 years at BlackRock, definitely the most traditional of people on this panel, where we launched the largest ETFs in history in the crypto space, as well as the largest tokenized funds in this space. Really happy to be here.
Awesome. Well, thanks for being here with us. But before jumping into products and financial products related to crypto, et cetera, I wanted to chat with you guys specifically about kind of, where we are in the state of the market and kind of what's going on. Obviously, we've seen massive drawdowns in altcoins and Bitcoin, et cetera, but where are we in the cycle? And for many of the folks listening here today, what is a cycle? From your guys' perspective, let's just open it up and would love to hear whoever wants to take it first.
Sure. I think if you're a short-term speculator or you're a trader, you feel really bad about the state of the crypto markets. But actually, if you're a futurist, an investor, an institution, now may be the most exciting time in crypto. Ethereum's been around for 11 years. Bitcoin's been around for 17 years. And the level of institutional adoption is like nothing we've ever seen before. And I think we're in the bottom of the first inning around stablecoin adoption, tokenized real-world assets. And I believe very strongly that if Clarity Act passes, DeFi will become the execution layer for most of finance, with agentic being the automation layer. So I think if you're focused on short-term price movement, it feels very cold. But if you actually look at the fundamentals of what's happening, not in crypto, but in finance, you should be extremely bullish. And I would argue that the risk reward of entering the space right now has probably never been better than in the last several cycles.
Yeah, I would just add to that if you're not familiar with what a crypto cycle is, it's the concept of basically digital asset prices moving the same way any emerging asset has moved, right? So there's periods of expansion, of consolidation. Right now we're in a consolidation phase. But I agree with Joseph. I think there's a much bigger infrastructure upgrade happening beneath the markets that continues to happen regardless whether the price is up or down.
Yeah, I'm going to say this is my fourth cycle, and this is a drawdown for ants if you've been through other ones. And even the high of last year was a lot less than a blow off top, which is what everybody was expecting. There were a lot of people that believed that the 4-year cycle was dead, it's over. I believe it's still in place, at least for a few more years. The reason why we have these 4-year cycles is Bitcoin is the largest asset, and every 4 years there's a halving that happens, and it really has to do with miners. So miners collect money by processing transactions, processing data. And when the halving rewards are cut in half, they have to spend more of their Bitcoin in order to pay for things like software, hardware, and utility prices. One of the reasons why the cycle looked like it was off last year from a percent increase standpoint was a lot of things happened last year that forced miners to begin to sell early. A lot of them were getting ahead of the current cycle that we're in right now, and energy prices went up pretty substantially. So that earlier increase in energy prices while they were beginning to sell out of their Bitcoin to pay for things, caused the cycle to be off a little bit, but it's still, the 4-year cycle is still intact. And right now we are, in my opinion, at the bottom of the current cycle. There is a chance that Bitcoin could go back down into the 50s for a brief period of time. But the consolidation has happened. We're moving forward now at a pretty great rate. And the really interesting thing about this coming cycle that I believe is going to be a little bit different than previous cycles is the increase in tokenization of RWAs. And I believe that a lot of the tokens that represent chains that are strongest in tokenization are going to be the ones that come out ahead in this current cycle. So that's where we're focused on.
That's awesome. That leads directly into the next question, which is why do you guys think this technology, price action aside, has the ability to reinvent capital markets? And Joseph, I know you've spoken on that quite a bit. Stephen just kicked things off there and teed it up quite nicely. What's your take on that?
I think it's just an upgrade of an archaic financial system, and you can just think of it as akin to digitization of a process. I worked at the world's largest asset manager. I had a front row seat on how inefficient it is. The idea that if you trade an asset, you don't receive the asset for a day. And if you trade it on a Friday, you don't actually receive it till a Monday. And if your country goes to war on a Friday night and the markets are closed and you want to express your views on your portfolio, you can't do that. And so the idea that 24/7 with instant settlement, credibly neutral, and I'll translate that into TradFi, no counterparty risk, no settlement risk, credibly neutral, decentralized are words that actually have meaning outside the crypto space. And then the final thing that I think we're largely underestimating is this idea that retail investors right now hold a stock or a bond or a fund, and they do very little to make it productive. You hold cash, it's idle, there's not much you can do with it. When the world of stablecoins plus tokenized assets plus decentralized finance happens, anyone can own a tokenized version of anything. It will be composable, which means you can borrow against it, you can lend it, you can use it for leverage, and that will allow retail investors to almost have a CFO in their pockets. If you're at BlackRock or a large institution, they have people who wake up every day trying to make sure no idle cash. If I own a stock, I'm lending it. If I have some other fund, I might use it as collateral. These are things that are going to be part of daily lives, and I don't think you're going to realize you're on the blockchain. We're going to completely abstract the user experience, and no different than using your phone or apps, you don't think of what sits under it. So you can think of crypto being the iOS of the future of finance, and I think it's going to create tremendous prosperity, not just more transactions.
Awesome stuff. Social, any thoughts, or Stephen, any thoughts just in terms of technology, where we're going with it, et cetera?
Yeah, maybe just to give a concrete capital market efficiency example to add to what Joseph said. So we recently at Anchorage launched something called cashless reserves. We launched this with JP Morgan and Solana. And effectively what that model replaces is the traditional model where stablecoin issuers hold on to 10 to 15% of the reserves in order to service redemptions. So this model essentially, what it does, it makes sure that the reserves that you have are now sitting in yield-generating, low-risk tokenized instruments, and it can be made cash on demand. So that's a real example of how this efficiency is happening today.
Yeah, I mean, I got into blockchain full-time about 10 years ago, and the primary reason was I was a former bond manager, bond trader, and I focused, if you're trading benchmark bonds, your settlement date was anywhere between 1 and 3 days at that time. It's gotten a lot more efficient. But if it's non-benchmark, which is over 50% of the rest of the bond market, your settlement time could be anywhere from 3 to 30 days. So think about that for a moment. If you're trading, esoteric fixed income, bank loans, high-yield bonds, or structured securities, then you might have to wait 30 days for that settlement to happen. Now, that wasn't always the case, but that was the outlier case. Commonly, 10 days was the settlement period. And I saw an opportunity for utilizing blockchain to make the bond market more efficient, and that's really all I thought about, and I ran emerging markets as well, and and if you really dig into markets around the world, there's people that come here to work, to go to other places to work. They have to send their money back home, and oftentimes, so let's say that you're living in a country that's not the U.S. or the U.K., you actually have to trade that currency for pound sterling or U.S. dollars, and then trade it back into your home currency. And that's two different layers of fees that people are paying for their hard work, for their hard-earned money. So those two things combined, I think were the main reasons why I got into this. And 10 years ago, a lot of us were doing tokenization, and it just failed because there was no market for it. We were building all this technology, we were building processes, talking to the SEC, talking to Congress. And it was great. We got a lot of things built. And now, is there a market? I'm going to argue that there is going to be a market. There already is a market for stablecoins, which is extremely important. And that market is quickly expanding into other real-world assets and other types of securities that aren't as efficient in the market as, say, ETFs and equities.
That was a great, kind of answer there. To follow up just specifically on the stablecoin piece, can you kind of jump into that? That was something that I wanted to touch on later, but let's just talk about it now. The purpose of stablecoins, what is that market? Why is it important? And who are the users? And, who are the big beneficiaries? I think it's very, an interesting concept given that we're in DC and, a lot of these stablecoin issuers hold a lot of paper.
Yeah. Well, there's a lot of people around the world that have been using stablecoins for a very long time. It's a much more efficient way to send money, right? So let's imagine for a moment that you're a video game developer, okay? And you've got studios around the world, and then they outsource to developers around the world. So you might have a studio in Australia, and then they're outsourcing to Romania, and just the simple method of paying people is a pretty big task. So stablecoins allow that payment to occur instantaneously. For years, you've been able to pay somebody within seconds with a stablecoin that they can then use to buy things or to pay other people. And as that particular area of the market begins to progress, not just in U.S. dollar stablecoins, but in stablecoins for other currencies, and then creating trading pairs for those various currency stablecoins, it gives billions of people access to markets when they can't even access a bank. And that is really where this is all going. The importance of the U.S., understanding that, look, there's a lot of people around the world that want to have dollar stable coins because they are stable. U.S. dollar is the most powerful currency on the planet right now. And to have these stable coins that are essentially buying U.S. debt to back it, which is pretty brilliant. But buying U.S. debt that helps us as a country, but it also helps the stablecoin providers as well create a stable backing for the currency that people are trading.
Yeah, that was a great answer. All right, let's jump into another topic, which you guys are the experts on. Let's jump into regulated financial products holding these types of digital assets. Just to get started, Joseph, would love to kick this first question over to you. Would love to get into all the intricacies of DATs, but I realize, we have a lot of folks here in DC. What are DATs? how did we get DATs, and kind of, what is the purpose and the mission of them moving forward?
Sure. DAT is an acronym for Digital Asset Treasury, and the first digital asset treasury was Michael Saylor, who believed that there were a lot of investors who wanted to own Bitcoin, but they only had two ways to own it. They can open a crypto wallet, onboard, try to get cash in there, and then try to understand how to custody and take risk of owning Bitcoin. It's called owning the spot token. Digital asset treasuries were essentially an invention where they're a public company. You can go on New York Stock Exchange or NASDAQ. If you want access to Bitcoin initially, you just buy the stock and you get access to it. You don't have to worry about custody and the like. Last summer, there was almost a summer of digital asset treasuries. I lead the first and now second largest digital asset treasury on a token called Ether. It's a token on the Ethereum blockchain, which basically transacts over 50% of stablecoins, tokenized assets, and DeFi activity. But Ethereum is a slightly different animal than Bitcoin. Bitcoin is not productive. I've launched the largest Bitcoin fund in history, but you hold it as a store of value. It's like digital gold. You hold it because you believe your government is going to debase your currency. It's like a hedge. Ethereum is programmable, and Ethereum has staking yield, where if you own ETH, you can put it back to secure transactions, and you get about a 2.75% yield. So the idea was, if you want access to this long-term Ethereum opportunity, you want to own Ether, you can kind of try to go buy spot Ether, deal with the custody, try to learn how to stake it and get the yield yourself, or you can buy an ETF, and when we launched, ETFs could not stake, so you were missing the yield, or you could just buy a public equity. And last summer when we launched, we raised about $3 billion from investors who wanted access to this vehicle because they believed in the long-term Ethereum opportunity. And then there were digital asset treasuries on Solana and a long tail of crypto tokens. So you can think of it as
also
an exposure
INJ.
vehicle. That's right, on Injective, because each of these chains and tokens has a thesis on how they're going to help transform finance, and owning the tokens via public equity is just very efficient if you have a strong management team.
Totally. So jumping over to social, you chat with institutions every day. Kind of what's the common theme across what you're seeing in terms of institutional investors, and what are they looking for from a custody trading services perspective that is relevant to a lot of the folks here from legislative perspective?
Yeah, maybe even narrowing it down a little bit more, how the question has changed from, I think, the introduction of DATs and ETFs right now. So the most common question that I get, that we come across, is who's holding the assets and under what regulatory framework? And that question hasn't really changed. It's more that it's gotten more sophisticated over time. But it's very different from 2 years ago when I was, just like you, on the institutional side at the blockchain network, when the question was more, well, are we allowed to participate, and what happens with this? Now, institutions have gotten very comfortable with regulated custody, federal oversight frameworks. And so now the question effectively has changed from, are we allowed to participate, to how fast can we move? And that's a really exciting change, I think, that ETFs and DATs brought. And also to credit the work that Steve and Joseph are doing, ETFs and DATs brought in effectively this whole entire new universe of institutional buyers that wanted exposure to the asset, but really weren't able to hold it directly. They needed a familiar wrapper to do so.
Totally. Well, to that point, Stephen, let's jump over now to ETFs. Obviously, we know about the big Bitcoin ETF that's driven a ton of flows. What does that look like in terms of evolving? Also, outside of that, what do we expect in terms of new ETFs? Hopefully, an INJ ETF, but Stephen, the expert there, as he leads Canary Capital, kind of give us what that looks like.
Yeah. So I've been involved. I got involved in ETFs accidentally, several years ago, and then when it looked like things were going to change. As far as regulation goes in the U.S., we had, my previous company had filed for a Bitcoin ETF, which launched. But while we were waiting, we focused on some of the ones that were in and around Bitcoin. We actually launched the first DAT ETF. We called it Bitcoin on the balance sheet. And at the time, there was only like Tesla and MicroStrategy that qualified, and then a few others that held Bitcoin that were publicly traded companies in various ways. We also launched the first Bitcoin mining and Bitcoin futures ETF on Nasdaq, and those were really interesting products. It gave investors the access that they were looking for ahead of when the whole slew of ETFs were approved several years ago. Now we're focused on, as I mentioned, ETFs of tokens that have usefulness and things like RWA tokenization. So we've launched 5. We just started the company a couple of years ago. We've launched 5 ETFs in the last year, and we have another 3 or 4 this year. Hopefully, Injective is one of them. You still have to go through the process.
Fingers crossed.
Yeah. Hopefully, you still have to go through the process with the SEC, right? You file an S1, you get comments, you go back and forth. There's other requirements that came along about a year ago through generic listing standards after Bitcoin and ETH were launched as ETFs. So once that got passed, it became easier to launch token-related ETFs. So I believe that there's going to be a good amount that will do well. There's probably going to be about a dozen, 2 dozen that are really strong, and again, mostly tokens that are doing real work in tokenization.
So to all those products, as a follow-up to that, who are the marginal buyers? I mean, Social, I'd love to hear your thought from a trading perspective, et cetera, but then also coming down the line here, who are the marginal buyers if you can just go and buy this stuff on Coinbase or Kraken of these types of wrapped financial products?
Yeah, from where I sit, or as a custodian, what we see is it's asset managers, it's banks, and increasingly it's also corporate treasuries, and not necessarily because they just woke up and discovered crypto, but because now they're more familiar with the wrappers, the regulatory wrappers that are being used.
Yeah, when we first launched each of the ETFs that we launched, the first buyers were retail, and a lot of retail investors, sure, they can open an account on an exchange, but it's a lot easier to hold it in your brokerage accounts and trade it in your brokerage accounts and manage it there, right? So there's a lot more protections there for them as an investor. Not everybody is sophisticated enough to create your own hard wallet and learn how to trade. Certainly, when I first got into Bitcoin many years ago, it was a nearly impossible task. Unless you were a high-level programmer, you're going to lose your money. A lot of people didn't, but some people did. But as we've progressed and as this has become a lot more commonplace, we're talking to a lot, financial advisors are deep into buying crypto ETFs, as are insurance companies, pension funds, and even sovereign wealth funds. Sovereign wealth funds, I think, are going to be the next big iteration in inflows. Insurance companies are going to be a little bit further behind because of the way that their capital treatment works. So you have to hold about 30% in cash to hold a crypto ETF or crypto in general, just like you do with a private equity fund or venture capital fund. So it's a lot less efficient for them unless you can create an instrument that they can actually use, like a structured product. So insurance companies are probably going to be very last in adoption, but sovereign wealth funds are the ones that are the biggest buyer right now.
Yeah, I'd love to hear your thoughts. I know you guys are in the public markets. Congratulations on another large fundraise. More recently, how does it working in the public markets or capital markets specific to what you're doing at SharpLink?
I think last summer, when you had the summer of digital asset treasury launches, there were like 50 Bitcoin treasuries, 6 or 7 Ethereum, a number on Solana. It was largely a fast retail momentum trade. You had a lot of Asian retail investors in Korea, Hong Kong, Singapore, Tokyo buying. It's transformed nearly 100%. When I started SharpLink as a digital asset treasury, we were 6% institutionally owned, 94% retail. Today, it's over 50% of my investors are large institutions, funds. Fidelity's our largest investor. As you said, they can't necessarily hold and custody spot ETH, so they get exposure through us. And even insurance companies, they view us as a public equity, and they just have tax treatment and RWA treatment as a public equity. I think the biggest challenge, you started with the question of price of crypto. I think you didn't ask this question, but I'm going to answer it. The biggest challenge in crypto today is we don't have the next retail incremental buyer. Much of the retail buyers of crypto have now moved to buy Samsung and SK Hynix and NVIDIA and SpaceX, another risk-on asset that they see having an ability to go up 5x, 10x. And until that cycle breaks that you were talking about, and we're able to attract not just institutions, but the next retail buyer, I think it's going to be a bit of a consolidation period and a challenging period. But these things rotate, they move in cycles, and I'm quite confident that, again, the risk reward of entering now is pretty strong.
Yeah, no, great answer across the board. Well, while we are here outside of Capitol Hill to discuss policy and how that's relating to everything that you guys are working on. So, Stephen, I want to start with you. Give us your take on Clarity Act and how that's specific. I know you might have an interesting take based off of the dinner I had last night, but what's your take on Clarity and how that's beneficial for this entire industry and in specific the products we're discussing?
Well, the first thing I should mention is that whether Clarity passes or not, it has zero impact on my business. We've been running this business and in previous iterations other businesses that we just simply follow securities laws. It does have an impact on other people's businesses, so I don't want to belittle that. But I think most of Clarity is actually good for the entire industry. There's a couple of areas of Clarity that I don't really think should be in there. And this is where it gets controversial and people argue with me. But for instance, the piece that says that stablecoins should be able to distribute a yield, I don't think that should be part of Clarity. I think that falls under the 1940 Act. It's very easy to simply put a 1940 Act wrapper around these products and make them securities. And they can still be traded by retail investors. One of the reasons why I don't believe that you should be able to distribute a yield on these stablecoins unless they're securities, because they're buying and selling and holding, for the most part, U.S. Treasuries and other bonds. And that activity alone, and you distribute that yield, that makes you a mutual fund. So you should fall underneath mutual funds if you want to make the distribution. If you don't want to make the distribution, fine. Tether makes a lot of money by not making a distribution, and they probably want to continue to do that, as does USDC. So, but to force an act that does that, well, what comes next? Okay, well, all the asset managers, which I formerly ran mutual funds, are going to raise their hands like, well, what about us? Where's our exception? We don't want to have to, we don't want to have to fall within the 40 Act to be able to distribute the yield that we're earning within our vehicle. So that's the biggest piece that has the most amount of argument right now between crypto and the banks. And even though I'm in this industry, I think the banks are right.
Yeah, so I guess interesting take, and we can jump around, but beyond any single bill, kind of what would you guys see as the most kind of important things for lawmakers or regulators to understand in terms of accelerating innovation? And Social, would love to start with you and then bring it over to Joseph. I know Anchorage has been federally regulated for over 5 years now. What does that mean in the context of your day-to-day business? How has that been helpful based off some of the things we've heard on the panels today? And would love to kind of give you the floor there.
Yeah, maybe I will preface, I'm not a regulator myself, of course, so I will keep it a little bit broader, but for the implications on the operator side. For example, federal supervision for stablecoins, I'll just make it very practical, what that entails, right, for how we've been operating in the business. That in itself basically means that It's a fancy way of saying that stablecoins now have to adhere to all the guidelines and this full suite of services that any national bank has to adhere to, right? So think capital and liquidity requirements, AML compliance, all of the exams, audits, all of that. For the stablecoins that we issue at Anchorage, all of those, the federal oversight there applies through everything, right? So throughout the entire flow, how reserves are being held and managed, how redemptions are being done, the full operational stack, essentially. There's federal oversight every step of the way. And what that does for institutions in turn, it makes their lives so much easier, right? They now recognize the frameworks that they're working with because it's similar or the same as the one that they're operating in. So I think federal oversight, long story long, is very positive for institutional adoption because it gives the serious players something to build against.
And it's very impressive as well. But Joseph, would love to kick the question over to you. Hear your take from a public market perspective.
Well, we're a public company, so we comply with all U.S. public company rules. I think there is a micro impact and a macro impact if clarity doesn't pass or the regulators don't rule make what we need to have done. One is just sentiment will be really bad, and whatever cycle you believe in or don't believe in will get extended. And I think that's bad for the industry. I don't think it'll really slow down tokenization and stablecoin growth materially, but the sentiment will be bad. The macro impact is, I have not been to Europe in a year. I've been to Asia 5 times in the last year. And if you go to Seoul, Tokyo, Singapore, Hong Kong, and Taipei, they're watching what's happening over here really, really closely. And the crypto industry, the fintech industry will literally copy the moment that Clarity Act happens. If Clarity Act doesn't happen, they're going to move just as fast to seize the momentum. And we're going to be back in the days where you have development and stable coins moving offshore. And I fear that America will lose some of its competitiveness. And you can't stop technology innovation. This will slow technology innovation in the United States. I believe very strongly that the Genius Act was passed first for exactly the reason you mentioned. You know, Tether and Circle, the 2 largest issuers of stablecoins in the world, are the 12th largest creditor of the US government. So at a moment when Russia, China, Europe is slowing down purchases of US treasuries, like having more buyers of treasuries is an amazing thing. And so I believe the geopolitical impact will be bigger than any other impact we're talking about today.
I totally agree, and I think that's something that people don't necessarily focus on as much. Well, all right, I kind of am out of questions. You guys have been fantastic. I'd love to allow you guys each a couple minutes in the room with regulators to kind of give the perspective pitch of, you know, you come for 3 of the largest and, you know, most credible institutions from, you know, the crypto side of things. So, Rachel, would love to start with you and kind of, you know, have you take the floor in terms of giving the room kind of, you know, what they should be considering in terms of rulemaking and the future of innovation for this asset class.
I'll keep it to custody in that sense. I think people in the room often think about Anchorage as a vault, and we're not, right? We're essentially a piece that makes participation possible in the space. We enable participation, whether it's staking, governance, stablecoin issuance, you name it. So people view oftentimes, or a misconception that people have, is that custody is passive. And really, the role that we do have is making it possible that every single product in this room can exist today, right? There is no ETF, no stablecoin, no treasury strategy that exists without trusted infrastructure underneath. And so we're not the most exciting part of the story, maybe. I think so, I'm maybe biased. But we are the part that makes the story real. So consider custody as enablement, not as a vault.
Yeah, I actually think that the most important thing that happened was the selection of Chairman Atkins to the SEC, and it's really transformed the SEC into. I mean, the staff itself, they've always been very keen to work with us, over the last many years, but this does allow a little bit more progress from the SEC standpoint. for instance, there was no reason why Bitcoin as an ETF should not have been able to be launched back in 2017. So the SEC is taking a different type of stance here. And it's not laissez-faire either, which is actually a concept I believe in, but you still have to work through the process, right? It still takes months of comments on S1s to be able to launch an ETF, and that's really where I'm focused on right now. But it is still a long process, but it's a good process. Making sure that proper disclosures are there, making sure that proper processes are in place from an asset management standpoint to make sure that you're not going to lose money. But I think that's the most important piece right there is the regulators.
Look, in my previous work at BlackRock, we spent most of 23 talking to the Biden administration and Gensler about their priorities. And I think if you're a leader, you need to understand the priorities of the people you're sitting across. And a regulator and a legislator in this space should have three priorities: protecting the market structure and participants, protecting investors, investor protection, and creating the sandbox for innovation. And when we were speaking to the SEC, asking for permission to launch the first Bitcoin ETF in the US, we didn't try to fight them. We explained to them that this is good for market structure. It's actually going into the hands of regulatory fiduciaries who are going to manage these. It's much better for investors to have custody and asset management through a BlackRock, a Fidelity, a Franklin Templeton, than it is for them to go offshore to an offshore unregulated exchange and buy Bitcoin. And in the case of Clarity Act, I would argue that please don't let perfect be the enemy of the good. This is going to be great for investors. It's going to be great for financial innovation. It is going to rewrite market structure. And we know technology progress cannot be stopped. We are going to rewrite the rails of all of financial infrastructure, help us do it, and give us those guardrails so investors, market protection, and innovation can be put first. But it comes down to understanding what their role is and then explaining to them that this is good for their three priorities as well. That would be my take. And I have a lot of scars from doing that, from a very hostile administration to crypto. But ultimately, I think education is how you do it, not suing or fighting your regulators.
Well, incredible stuff and very well put by these three panelists. I don't want to hold anybody up here any longer. Again, thank you all, and let's head out. And Frank, I'll hand things back to you. I think you might know what's next.
Cooper, that was amazing. You did a phenomenal job.
Thank you to Injective.
Has anyone ever told you?
Welcome back to the Injective Summit live stream. I am excited to sit down with Sunayna Tuteja. Welcome. I'm happy to be here with you. You were previously serving as the Chief Innovation Officer at the Federal Reserve Board, and you focused on financial innovation, technology, regulation. Now you're bringing more of a unique perspective to the space on how policymakers and the private sector can work together. So lots to talk about, but welcome on.
Well, thank you. I like that we can, be very efficient. We can nerd out about these things and get our vitamin D. So
Yes.
This is great.
Yes, we're getting a nice tan. We've got the sunglasses. It is sunny. So thanks for being a good sport with
It's
me.
all good.
But you've sat at the intersection of government and innovation, and the government moves kind of slowly, and innovation on the front of startups and tech moves pretty quickly. So how do you think about the speed at which they both move, and then making sure that we don't fall behind because we have to kind of, work at each other's pace, so to speak?
No, and that's fair. Public sector is often connected to, the risk averse. And listen, being risk averse is not a bad thing. Right? When you think about your central bank or regulatory agencies, you want them to be prudent. Break things and ask for forgiveness is not a good trait. However, that also then gets used as an excuse, and that can't happen, right? Apathy is not an option. So it's about balancing those, two attributes. So at the Fed, one of the things, we looked at was this model that I like to say, my team, think of them as like the speedboat to the aircraft carrier, right? Like the aircraft carrier, even at full throttle, is only going to move at a certain speed, and that's okay because you're running the day-to-day business, you're, accomplishing the mission, doing important things, but at the same time, you're sending out these speedboats into like the new frontiers to understand these new technology and get that hands-on keys experience in the context of that agency, and then making a decision how this applied within that agency, but more importantly, how you should be thinking about as a policymaker, right? Because the last thing I would just say is, yes, there's a risk of doing new things, but oftentimes the risk of not doing new things can be greater than the risk of doing.
Yeah, no, 100%. I agree with you. And I think on the front of, you said hands-on, and I liked that because I think it's important for people to be testing things out to actually understand it. And so are you finding that policymakers and regulators are using the technology behind like blockchain and AI and have that hands-on experience? And if not, how do you encourage them to go ahead and do that?
Yeah, I would say if there's one thing I was super adamant about and continue to be, is this notion that as policymakers, you have to have hands-on keys experience, right? Because how can you render smart, actionable policy and guidance to your constituent if you do not have, again, that hands-on keys experience? Like you can't, when new technologies come out, you can't sit there and admire it. You have to take action. The cheeky analogy I use is, let's say you signed up to run a marathon. Okay, are you gonna sit there and watch YouTube videos of other people running
or
a marathon?
hear about running? Right. I've heard running is good.
Exactly.
Yeah, exactly.
Like at some point, you're gonna have to lace up those shoes and get out there if you want to train for a marathon. So that hands-on keys experience is important. And and my friends in crypto will know this. Like when the early guidance for crypto was coming out, it was abundantly clear that some agencies and some regulators, it's like, have you ever used a MetaMask?
They didn't know what they were talking about.
Exactly. So that hands-on, and I think with AI, I'm seeing, regulators do this differently, and at the Fed, right away, it was enabled for everybody, so people could have that day-to-day understanding, so they could formulate policies from that, lived experience, I suppose.
So you think they're understanding, they're using it, right?
They're applying it from a Fed context. We made a decision. So ChatGPT came out in November 2022.
Yep.
Like early 2023. It's like, how do we activate this? Obviously, again, in a prudent manner, away from production systems, but enabling it for everybody so that folks could use it and understand it, and then formulate use cases. The other important thing, though, is oftentimes innovation does get a bad rap because it looks like it's innovation theater. It's like chasing shiny objects, or you are left with a bunch of zombie projects, right? So there is a burden of proof from the folks that are doing the front end frontier work. Is you've got to start with, what are the gnarly problems you're trying to solve, right? Like, what is that business value you're trying to create with these new technologies? Because if you anchor it to that, then it's not just about, we're just chasing a new technology. It's, we're doing this, but generating meaningful value.
Right. Another big theme is on the front of blockchain technology and AI, especially on the front of agentic payments. But it feels like there is more focus heavily on the AI front. Outside of this industry, everyone's talking about AI. Even in this industry, we're all talking about AI. Where do you stand on this?
I think the level of dynamism in AI, obviously, everybody sees it. I think the level of dynamism in like the crypto world and blockchain is equally equally needed. In some ways, the intersection of these two things could not be more timed. Like, let's use the example of agentic commerce. Everybody is excited about the potential of agentic commerce, as am I. But for agentic commerce to really happen and happen at scale, it's going to need a monetization layer. And stable coins are perfectly designed to be that payment layer. And guess what? it's a 1-year anniversary of Genius, right? How cool that we have a US dollar denominated stable coin that's right there to power that. So that's that intersection, like agentic commerce powered by AI actually needs stable coins powered by, crypto, blockchain. So, that type of intersectionality. And I'm seeing other examples. Actually, I've been meeting, one of the things I have started since I've, left the Fed, amongst other things, is, restart my angel fund. And as part of that meeting, a lot of blockchain builders who actually AI builders who actually used to be blockchain builders, and how they're porting stuff that they built in blockchain, because things like provenance, immutability, those are traits that are going to be required to solve some important problems in AI use cases.
Where are you seeing regional differences on this front? Because I know you told me you were traveling recently. Is the appetite for AI technology similar or different compared to the US market?
It is fascinating. I mean, if you think about it, bulk of the AI innovation starts in the United States and is happening in the United States, which is exciting. But the tone in the United States can be a little spicy and sometimes doomerism, which perplexes me. I was in Europe a few weeks ago. Not surprisingly, the tone in Europe is very much, let's start with regulation, that's what my European friends like to do. Yeah. I was recently in Asia, just got back from Japan. I was pleasantly surprised to see how the tone actually in Asia is much more supportive and much more pragmatic. And again, if we want the world to be using AI that's built on American stack, I do think we should be thinking hard about the type of tone around AI in the US. Not to say AI is perfect in every which way, but this is an innovation that stems from the United States, and in many ways, we should all be excited and proud and power it.
Yeah, 100%. Amazing, Sunayna. Thank you so much for taking the time to sit down with me today. It was a pleasure.
Thank you for having me.
Yes. Thank you. Good?
Okay.
Yes, thank you so much. I appreciate it. What'd you think?
It was an easy conversation.
Yes.
I hope you did.
Yes, of course. You're great at it, so make my job easy. I know, it's a little hot. Very. How kind. Okay, I need to know about the orange ones though, because I heard they're crazy.
Absolutely the same.
Yes.
So are black ones. She's my only girl, and she doesn't have a tail. She's got like a little chicken nugget.
Stop
It's so cute, but we just don't know what happened to her tail.
I have to see that.
Yep, just give me 1 second.
I'm Polish, I can speak up easily.
Okay, yep. Yep. Welcome back, everybody. Joining me now is Stacy Cook, Senior Director of Global Risk and Regulatory Compliance at MoonPay. Stacy, welcome.
Hi, thank you. Thanks for having me.
Yeah, how's your conference so far?
Oh, it's been wonderful, and we have a beautiful day, no rain.
I know, and beautiful view, right?
Yes, love it.
So you joined MoonPay in 2023, I believe, so sort of the height of regulation by enforcement, as it were. How has your job changed in the last 18 months? Because we are no longer facing that regulatory sort of scrutiny, as it were. The crypto industry is not. It's a bit of a regulatory friendlier environment, I would say. How has your job changed?
Yes, so I joined MoonPay after I was at Robinhood Crypto. I had a beautiful experience there, and I love to embrace any challenge. So I had the opportunity, my boss called me for the position at MoonPay, and when I joined, we were really striving to have a culture of compliance at MoonPay. And with all these enforcement actions that were being taken across the crypto firms, we wanted to make sure that we were assessing what was actually being enforced and work towards making our program and our company compliant. And so it was a great experience. The first 18 months was a lot of work, but we really hunkered down, and we documented, and it just allowed us to excel and be in a good position from a regulatory compliance perspective.
That's great. It's such an important thing to have these days. The compliance standpoint, I think, is just, I think it always has, but just, it's really become in the last 18 months really forefront and center. With that friendlier regulatory environment, we're seeing a lot more capital, a lot more talent coming back into the United States. Institutions are happier to work with crypto companies these days. In fact, they're asking for it. How have you seen this manifest in MoonPay?
It's been a wonderful journey for MoonPay. MoonPay offers ramps, exchanges, commerce, and stablecoins. So we are actually able to work with all those institutions that are coming back into the US and opening up a remit of digital assets for their customers as well as our own customers.
And where are you seeing the biggest demand for stablecoins right now? Because MoonPay really kind of sits in the middle of payment rails and stablecoins. So where is sort of the biggest boom that you're seeing in terms of that? I mean, we're on the anniversary of the Genius Act, so it really is a perfect week to talk about it.
Yes, well, as the question was, our institutions, our partnerships with those institutions has really just boomed, and we have a beautiful relationship with our internal stakeholders in partnerships and sales to make sure that we are providing the ramps and services for those institutions.
A big part of what we're talking about and seeing right now is Clarity Act. Will it pass? Will it not? Questions that we don't know the answers to, but I'm sure we will find out relatively soon. AML, KYC, compliance, big part of that. What are you seeing in terms of the understanding around some of the things going into that bill? I mean, if Clarity passes, what's going to change for companies like MoonPay on the risk and compliance side?
So for MoonPay, currently we are working with many licenses across the globe. We have 47 state licenses. We are licensed and operating in many jurisdictions, such as EU. We were one of the first crypto firms to get our MiCA license. UK, Ireland, Jersey, Australia, the list goes on
everywhere.
and on. Yes, so because of that, because we are a global firm, we have to comply with all those AML, KYC, KYB regulations, and it's not cookie cutter, it's not simple, it's not streamlined. So we really have to partner together, at least in the compliance team, to make sure that we are adhering to every specific one. Now, when it comes to US and the Clarity Act, this really will help streamline those compliance controls. And it will make it a lot simpler for us to make sure that we are getting those controls across the globe in an easier and smoother manner.
And then if Clarity doesn't pass and it kind of goes back to maybe that patchwork of state regulation that companies have been working with, is that just something that's going to have to, happen? Do you guys have a plan in place? Is it just, we're going to just keep going with what you've got at the moment?
Yeah. What's beautiful is that we're already doing that at MoonPay.
Right.
We're already maintaining
status quo.
It is status quo,
Yeah.
and we are okay with that because we are licensed in so many areas. We're accustomed to having to, pivot and turn or adjust depending on the license or the regulatory body that's overseeing us. So for MoonPay, it will just be maintain as we're doing, and in hopes that Clarity Act will bring some unity to those regulatory
Business as usual.
Exactly.
From an AI perspective, I know you guys have been leaning into AI very hard, specifically around agentic payments. From your side of things, the risk and compliance job, how does that work with AI? I mean, it must be sort of a new frontier that you're dealing with on that side of things. Can you kind of explain your position around that with risk and compliance and how you kind of get people to trust AI and agentic payments, and how do regulators come in on this side?
Yes, this one is actually very tricky.
Okay.
We know from a regulatory perspective that there is regulation forthcoming. So hopefully, I think next year there will be one in the EU.
But a bill in the EU?
Yes, I think 2027.
Okay.
So we are really taking the approach of having the conversations with our product folks and our internal folks early. I always like to say, bring us in at ideation phase, so we can truly understand what it takes in order to provide not only regulatory compliance, but also what is best and safest for our customers. So when it comes to integrating agentic, CLI, we really sit down with them and say, okay, what are you trying to achieve? And what is it that our regulatory bodies are saying about this? If they're silent, then we're gonna take the approach that we feel is most comfortable for MoonPay and within our risk tolerance or risk thresholds, and we just try to push it out as best as we can.
And what are you most excited for in the next 6 to 18 months at MoonPay?
Well, as a compliance nerd and as how much I love policy governance, I really love to see, the regulations coming together and having those regulatory bodies talk and say, how can we achieve this in one way instead of 10 different ways that we have to look at from, a crypto firm perspective. So I'm most excited to document.
Mm-hmm.
I always tell my internal stakeholders, document so you can get credit, and having the regulatory bodies come in and ask us the questions or examine us, we can sit there and say, listen, we're doing everything we can. We have, some of the best legal and compliance officers that I have ever seen in this industry, and I'm proud to sit next to them and build it out. And I look forward to seeing what the Clarity Act and what the Genius Act does.
Awesome. So Stacy, thank you so much for joining us.
Awesome. Thank you for
Thank
having me.
you. Yeah, sure. And we are going to go shortly to Krista, who is over at Grayscale, I believe. And we're going to bring her in just a second. Yeah, I mean, it is warm out here.
Very warm.
Very warm. I don't know how we're wearing suits today, to be perfectly honest.
I don't either. We're hiding what's happening underneath.
Yes, we are. We're doing a very good job of it. So we're going to bring in Krista now. Awesome. Thank you so much, Stacy.
Thank you for having me.
Yeah, we'll see you soon.
Take care.
Alrighty then. Krista Lynch is the Senior Vice President of ETF and Capital Markets over at Grayscale. Come on in whenever you're ready. Hey again.
Hey, thanks so much for having me.
See, you are dressed for the weather. I am not. I am wearing a suit, and I don't know why.
But I don't have my sunglasses, but that's okay.
Yeah. How you doing? How's your conference?
Good. It's been really nice so far.
Yeah.
I spoke on a panel a little bit earlier, and then I did another interview. So It's been a busy day, but a very good event.
Awesome. Good to hear that. I want to start with some of this ETF outflow that we've been seeing. I think June was a record month for ETF outflows, something like $4.5 billion. What's going on in the market right now, and why are we seeing that?
Yeah, it is unfortunate. I think for me as an ETF practitioner, something that I always fall back on is the efficiency of the vehicle and its ability to handle this period of stress. So if we look at past periods of downturn for Bitcoin and digital assets, it's been much more volatile. I think now we're in a more mature stage where things are being absorbed by the market in a much more reasonable and less volatile way. Now, the ETFs specifically, as you noted, have had quite a bit of outflows, and the vehicle has been able to facilitate that. I think we had over $1 billion in just 1 month, looking back at the past month or so. And so it's been unfortunate for asset gathering, but at the same time, it has been compelling to see how efficient they've been. Now, I will say that we have had actually a period of net gathering in our 2 low-cost vehicles, so we're also optimistic that that is a sign that investors that are here for the long term are still drawn to the asset class, and they're finding these lower cost opportunities to get involved.
I was going to say, is there some recovery that you're seeing now in the last couple of weeks since the June outflows? I feel like July has been a little bit more of an upswing. Maybe not much, but a little bit better.
There's these pockets of optimism, and there are, I think, compelling things happening in the background. Like Clarity Act is still a possibility that passes. I think that would be a big tailwind for the prices of crypto, and other things that are being built in the back end that don't necessarily manifest in token appreciation, but it is still a lot of infrastructure build and things like that are additive to the ecosystem.
Grayscale was pretty much the reason that the Bitcoin spot ETFs passed back in January 2024. I remember I covered it at Fox Business. It was a monumental, market event and really bringing crypto into the mainstream. You guys just launched a hyperliquid ETF, which I find fascinating because, hyperliquid is not a platform that's available to US customers. You can buy the token, but you can't use the platform. So what is the investment thesis for people, institutions, customers of yours who are buying into this ETF? Like, what are you seeing trend-wise?
Yeah, so Hyperliquid has really become top of mind as a decentralized venue for perpetual futures trading. Perpetual futures really got a lot of attention in the past few months for their 24/7 nature and some other crypto-native features, but on traditional assets. So perpetual futures historically were really on crypto underliers, but the Hyperliquid feature or the hyperliquid product on oil was really something that caught a lot of investor attention in the past few months with news coming out of the Middle East, oftentimes when markets in the US are closed. And so that's been really something that I think illustrates demand for crypto native features like 24/7 trading, availability of the perpetually rolled future, this kind of concept of the perp, in US markets. And hyperliquid is really the intersection of that. It's a way to capture conviction on convergence that this might be something that does become universally available in the US. And we're really excited to be able to bring the product to market, or the token to market, in ETP form.
And it was instrumental in pricing the SpaceX IPO as well. We had that discussion earlier. I think that was fascinating as well, something that such a novel new product, a new technology forward product that was better at pricing an IPO than the traditional underwriters was.
Absolutely, and I think as an ETF person myself, we always talk about ETFs as a price discovery tool.
Right.
I think this is the perpetual future also being a price discovery tool where markets are either closed, unavailable, or for whatever reason, it's able to illuminate the value of the underlying asset when it's not otherwise obvious. So for me, that's a super exciting kind of parallel between the assets that I typically work on and seeing this expanding further into digital assets.
How has the generic listing standards helped Grayscale's ETFs along? I mean, that was a big unlock, I think, for bringing a lot of single product ETFs to market. How have you guys seen that manifest since the approval of the GLS?
Absolutely. So it's paved the way for tokens beyond Bitcoin and Ethereum to come to market in ETP form, which really makes them more accessible to a wide range of investors. We now have over 9 tokens in single token ETP delivery mechanism through the generic listing standards, which for background is a set of rules that the SEC came out with last summer to really codify how a token can fall into eligibility. And that will continue to evolve over time. It's a living, breathing set of rules. But like I said, we have 9 different tokens that fall into that bucket now. And another exciting area is, as it expands, is an opportunity for asset managers like Grayscale to apply crypto expertise to be more selective about which of the now many assets are eligible that we actually deliver in this format.
I think when single product ETFs were rolling out under the GLS, there was thinking for a while that index ETFs were going to be a big boom. Correct me if I'm wrong, I feel like they haven't really kind of reached their peak yet. Do you expect to see that anytime soon, or do you see a continued sort of rollout and popularity of the single product ETFs? Kind of how are index ETFs doing at the moment?
Yeah, I love that haven't reached their peak yet, because I think that's a great way to describe it. As there are more options available on the menu, I think that the value proposition of an index fund becomes more and more obvious. So as you get more options, as you're able to move beyond Bitcoin in so many different ways, especially if you are relatively new to digital assets, that can be quite daunting. And an index fund like GDLC, our top 5 token product, is really a very eloquent way to sift through all of that. We've measured that it can actually capture about 90% of the return of the crypto marketplace with just those 5 assets. And then an investor doesn't have to go into the nitty-gritty about each of the available assets available in market. They can really just get that index product. So we hope over the coming months and years it becomes similar to the S&P 500, just a very accessible way to capture a broad swath of the crypto industry.
And then from an advisor standpoint, where are you seeing the most, I guess Bitcoin maybe, it's always in the headlines, right? Where you have, wealth advisors are now advising, a certain allocation of exposure to Bitcoin. Is it just Bitcoin? Is it going beyond Bitcoin into maybe ETH, beyond ETH now? I think at crypto conferences there's some talk around it's expanding beyond maybe Bitcoin and Ethereum, but what are you seeing from the Grayscale side of things?
Yeah, there's definitely instances where they're willing to have the conversation beyond Bitcoin, but it is typically focused on Bitcoin. And I think another exciting thing that's really brought more into the fold is this ability to in-kind into crypto ETFs, because advisors can now tap into not only clients who had no crypto exposure, but also into clients that had crypto exposure sitting on the sidelines, not in that advised portfolio, and they're able to use the in-kind transfer mechanism to now bring that into a holistic picture of what their client's wealth picture is. And then the client is able to get features like putting that asset into a tax-advantaged account, or perhaps having succession planning, things like that, that traditional brokerage accounts offer, but on that crypto underlier.
How are you thinking about tokenization if assets are coming on chain, eventually, 24/7, that's sort of the crypto thesis, right? Bring all real world assets on chain. How do ETFs kind of stack up against that? What's the sort of like investment thesis around that?
I'm super excited about tokenization, and I'm glad you asked that question because I was saying earlier, I think I go to a lot of traditional conferences where I think a lot of people aren't necessarily bought into why do I need to tokenize stock?
Right.
If it ain't broken, don't fix it. But if you think about the conversation on stable coins just a couple of years ago, it was very similar. It was why do I need to tokenize fiat? And now we see so many banks leaning into the efficiencies that this can drive. I think in a couple of years, the conversation about tokenization won't be why, but it will just be a given that we have this. So I see it as a huge area of opportunity. I think there's a number of different applications and ways that we can build with it, and it's definitely something that we're keeping a close eye on.
Will the customers ever really know the difference? I feel like I ask this a lot. It's like when you go to the interface and, is it just going to be something that I can kind of say, all right, I prefer a tokenized ETF or a tokenized stock because it settles quickly? Is that just going to be something that I can see on my end, or it's just going to be something that happens on the back end and it really is just going to be sort of the plumbing of Wall Street, as it were, that changes?
I think that the ideal end state is that it is the plumbing and that you as an individual investor are not necessarily having to actively make that choice. Going back to the ETF kind of landscape, I think about how the primary market and the secondary market works. You or I we really only engage on the secondary market. We might not even be familiar, a lot of investors aren't, with this thing called the primary market, but that's effectively the conduit for professional licensed traders to engage directly with the issuer. And I think of this selection between tokenized versus non-tokenized as that type of role, making the selection to have the most efficient delivery to their client, but the client doesn't have to deal with it.
Yeah, so really a lot of back-end efficiency.
And I think that part is exciting in a nerdy way.
I think policy is exciting in a nerdy way, so that's okay. Competition in terms of fee wars. I think we started to see a fee war. It really manifested right when the Bitcoin ETFs, spot ETFs came out. You see a lot of institutions getting into ETFs now. You got the banks, you've got Morgan Stanley, you've got Goldman. How are you guys thinking about that?
So ETFs have always been an area where there's a lot of fee competition. And I think one area of differentiation that we're excited about is with staking. So staking is an opportunity to demonstrate crypto expertise by having a better staking return, a better staking program. And so we spend a lot of time really working with third parties, trying to understand the landscape. How can we build the best possible staking delivery for our clients? And so I think, yes, it is definitely a highly competitive asset class. It's a highly competitive vehicle with ETFs, but there are still areas of differentiation, and we focus a lot on those. Now, having others enter the space and having it be competitive, I think also further legitimizes the asset class. For us, we already believed in it. We didn't necessarily need that. But for a lot of investors, having these kind of household names in the traditional finance world come to the table has really helped bolster support and legitimacy for the asset class, which helps all of us.
If clarity passes, if it doesn't, we're obviously watching this as a big catalyst for the space in the next couple of weeks. What is Grayscale watching around Clarity Act?
I think, no pun intended, Clarity Act gives clarity about what we can confidently invest in and build on top of. It's oftentimes a little bit surprising to people to hear that crypto practitioners crave more rules and regulations. But if you think about it, you're going to be kind of hesitant to deploy resources, time, effort, and focus on areas of build that could potentially be wiped out by a new rule coming into place. So having clarity gives better confidence and gives more opportunity to build towards the future. Also allows us to focus in on what are going to be the norms and the operating models for various ways that we engage with these new technologies.
Krista, thank you so much.
Thanks so much for having me.
We'll be right back.
I am here with Max Barris, who leads lending at Galaxy, which is one of the largest institutional digital asset firms in the industry. Max, how are you?
Doing well. Thanks for having me.
Thanks for being here. I mean, your team works directly with institutions who are navigating crypto, capital markets, and I think you're pretty well positioned to discuss how policy impacts lending, liquidity, and institutional adoption. What are you seeing right now, maybe from like a high-level POV, the most change in demand, maybe year to date?
Yeah, so I think that there's a lot going on in terms of institutional adoption. I think a lot of hacks happened in DeFi this year, so people are a little bit more hesitant to use the protocols directly themselves. We came out with a product this week, actually, called Gopher. It stands for Galaxy.
I saw this.
Yeah, the
Yes.
Galaxy on-chain financing rate.
Uh-huh.
Purpose of it, ease the operations for people who are looking to engage with on-chain finance. You can come directly to us. You can post us Bitcoin. You don't have to worry about wrapping it. We can do all of that on your behalf. We can then take those assets, we can put it on chain on your behalf, and then we can optimize between the different protocols that we have live, which right now it's Aave, Morpho, Spark, and Camino, and optimize for where we find the best rate, and then also have a number of different exploit controls in place that we've had in place for many, many years. So we've been working through all the different complexities that you have on chain. Really the goal of this is to bridge the digital native operations and tech that we've built out with institutions that see these rates and are interested to get access to it.
What do you think made the timing right now so significant to put out? I know I was talking to someone recently about kind of how like the lending market has been recovering since like 2022, and even like there are moments where we see it on like the buying and lending side, like with 1010 and different aspects, right, in the market.
I was going to say 1010.
Yeah, that's
actually.
more recent.
So
yeah.
1010 was when this product really came into my vision.
Yeah.
What we saw was the flash crashes were something that you couldn't really manage on perps and on-chain protocols. And as a result, we wanted to come out with something that was a little bit more white glove, where you could get access to the look and feel of everything that we just talked about, which is the amazing rates that they have on-chain, the ease of access of on-chain, but take away all of the complexities and some of the nuance. Stuff like flash crashes that could really mess up your market risk, where now you're trading out of a position you didn't even realize that happened, and it just makes the whole process a lot more smooth.
Yeah.
That's when it originally started. Then we saw the Kelp DAO hack.
Yes.
And after the Kelp DAO hack, it really kind of put a light that this is the right time for us to do it. We had an amazing response to the Kelp DAO hack, where we were in a position to move our funds very quickly. We utilize flash loans. We do all of the different things from like a DeFi institutional nature, where we have that 24/7 coverage, where we can really put ourselves in a position to make sure that we can access everything, but also feel really safe about our risk management practices.
Yeah. I also want to talk to you kind of just about the theme of institutional adoption. You brought up the conversations you're having with them, but like, what are you hearing the most from clients today as they evaluate different lending and then capital market opportunities within the crypto space? What are they interested in, and what are they like, we could get this in the normal markets? Like, they're still not fully on board yet.
Yeah, I think that it really comes down to the counterparty profile. Everybody sort of has a different thing that they're most honed in on. Some people it's risk, some people it's rate. And so we're trying to figure out what the right balance is. And so that lending's a relationship business. You have to talk to somebody. You need to understand, my most important thing is that you're not rehypothecating my assets. Okay, we can do that. We can then set them up with a custodian of their choosing. We're custodial agnostic. We allow them to then post their assets into that tri-party solution. They feel really good and safe about their assets, and then we can lend to them, maybe at a slightly higher rate, but that's sort of the trade-offs you get when you have to trade risk for rate.
Yeah. Is there anything specific now that they want more of that is surprising compared to maybe like 12 to 18 months ago, where it wasn't necessarily in the conversation?
I think yield on assets, I think staked assets are definitely a hot topic. I think the liquid staked tokens are definitely something that people are taking more of an eye towards. Galaxy recently acquired a company, Liquid Collective, and so now we have our own liquid staking outfit, LS ETH, LS Sol. But that allows you to pick up the yield on the assets when you're not using Bitcoin as your main source of collateral.
Yeah.
And it helps you feel like you're not losing out to sort of the, I'll say, negative arbitrage of the staking rewards that you want to just make sure that you're picking up along the way.
Most of the lending is on stable coins, right? Or is it
you
on different
lend
assets?
stable coins
Yeah.
against assets like a Bitcoin, Ethereum, Solana as the collateral asset, but there's also a decent amount of pair trades that are happening. So people are taking directional views on something like the Bitcoin ETH cross or the ETH Sol cross, where they'll borrow ETH from us, sell it and buy Bitcoin or buy Solana to take a directional view, as opposed to taking a market view. They're really taking a market neutral view, so to say, but taking a bet on a different coin. So it's everything.
Yeah. How much of the institutional lending activity today would you say is constrained by regulation versus internal risk management policies?
I think lending is pretty well trotted when it comes to policy. We have a pretty good framework. We kind of understand the do's and don'ts because lending has been commoditized. It's been around forever. It really comes down to risk management and the rate that you have associated with it. So I know we're sitting here on Capitol Hill, and
yes.
I'm supposed to say how important clarity is to
Yeah.
get passed, but I can be patient, I think,
Of
in my
course,
business.
yeah.
I want to see it get passed because I think that brings a lot of capital back to the market, and there's a lot of pockets within Galaxy and just around the crypto and digital asset ecosystem that would like to see the different things pick up from a clarity standpoint, just to bring the institutions into the market.
Yeah. I also appreciate that perspective because, like, I've asked this question before too, is like, not to be, pessimistic, but like, if it doesn't happen, clarity, like, can we all move on? And like you're saying, we'll be fine.
We'll be fine.
Yeah.
I mean, I want it to pass, don't get me wrong, but if it doesn't pass, that's not the end of the world. I think that it would be a nice cherry on top.
Yeah. And so, like, if regulatory clarity does improve over the next year, where do you see, or where do you expect institutional capital to flow first? Like maybe spot markets, lending, your side, derivatives, or tokenized assets, somewhere else?
Yeah, I think tokenized assets has been the one that people keep asking about. I think people are very interested to see a 24/7 market on all things, including digital asset securities. So I think once you have the market infrastructure bill figured out, you could see a lot more in terms of people utilizing the blockchain and the blockchain rails to accomplish a lot of what we already have, but just in a more efficient and better technological manner.
Amazing. Well, Max, thank you so much for coming on today. It was a pleasure.
Thank you.
Yeah. All right, we will be right back. We are going to be sitting down with Mirza from the Injective Foundation. Max, thank you.
Thank you.
Or maybe we're just staying, but that's totally okay. Good, how are you?
Good. It's so bright.
It is bright.
But it's kind of cool. You inspired me to wear my sunglasses.
I know, you look cool. We look cool.
I appreciate it.
Yes. Okay. Well, maybe no introduction needed, but I am here with Mirza. I've known you forever. Mirza, who is the head of business development at the Injective Foundation. He works closely with institutions, developers, ecosystem partners. He also is on the front lines of understanding what organizations need to move from interest to implementation. Mirza, welcome on, and thanks for sitting down with me and having me at your event.
Of course. Thank you for coming.
It's such a pleasure. I know, as I mentioned in the intro, you meet with all these different parties from like institutions, enterprise partners. Has the conversation kind of shifted from like, should we engage with blockchain technology to how do we implement it? And like, is the speed really there now?
Yeah, I 100% think so. I think a couple years ago, people would just say, the institutions are coming. It was a long-running joke and a meme in the industry, as you know.
Yeah.
I feel like they're here. Speed is an interesting question, right? So I feel like enterprises are actively engaging with people like us, with other major blockchains, names you would never think about before, like DTCC announcing they're tokenizing stocks, Nomura tokenizing stocks with us. There's just so much momentum behind enterprises. I think it's the speed has not been what I wanted to see, just because regulations have really not caught up as much as we hoped. I think after the 2024 election, a lot of people hoped that things would move at lightning fast speeds, but then governments and the American government showcased like, nope, governments are still going to be slow.
Yeah.
So we're still debating like things that we believe in the industry that should be just obvious, like things like the Clarity Act. So right now people are in wait and see mode. They're kind of seeing like, hey, what happens if Clarity doesn't pass? So a lot of institutions now are kind of waiting, and the market environment has certainly not helped. Where a lot of institutions were obviously going deeply into Bitcoin, and then they later went into the Ethereum DATs. None of those panned out well in the last year and a half. So there's a couple things, right? Like that was all my bearish takes. Now for my bullish take.
Now we're here. We're optimistic. We're in the sun.
So now for the bullish take.
Right.
It's that I think we have underwent the worst of it. So now the people engaging are not just here because prices are up. They are engaging because they're here for the long term, and the amount of institutional activity you're seeing on the back end is actually immense. It might not reflect in prices or markets, but the work being done right now, I think it far supersedes the work over the last decade in terms of people implementing, people integrating, new enterprises coming on board. So it makes me bullish for years to come.
Yeah, no, for sure. I mean, like, I would love to know at this summit, obviously there's a very strong policy focus. What are kind of the questions you're hearing from the companies that are actually exploring blockchain technology and then working with Injective for that matter?
It's a good question. I think now your first question was a good segue. Right now they're asking how fast can we move? And secondly, how can we do it in a compliant way? Everyone realizes that on-chain is the future. Everyone wants to be on-chain, but people want to make sure that a North Korean spy is not on the other end of things, right?
Right.
That's always the fear. So what they're really looking for, especially with people like us, is can you give us a blockchain that can put certain guardrails or certain KYC rails so that we know who our counterparty is on chain. I like to call it this public-private blockchain hybrid. So basically they want all the bells and whistles of what a bank would need. It's like, hey, we need compliance controls, we need proper guardrails, while at the same time they want the speed, they want the low fees, and they want the on-chain, a truly on-chain environment. And I think some of the things we revealed today, especially with Injective Mint and being able to issue assets with those compliance guardrails, are becoming immensely important because otherwise institutions don't want to move. No one wants to launch an asset just on Ethereum and call it a day because they're scared that regulators will stop it sooner or later. So they want to launch products that can keep going into the future without those roadblocks.
And who is they? Can we define who they is here?
Yes, we can define who they is.
Yeah.
I can be very direct. So they basically is banks. I think a lot of banks are looking into it. It's new stablecoin issuers. Everyone wants to issue their own stablecoin. Companies, enterprises, even different blockchains want to issue their own stablecoins now because it's proven proper product market fit. Like Circle, Tether, they both have. Thirdly, I would say a lot of the ETF issuers are trying to see, can we bring our ETFs on chain instead of just having a Bitcoin ETF on traditional rails? Can we bring it on chain because that has a new set of users? Number 4, and I think this is the most interesting part people are underrating, it's institutions abroad trying to enter the American market. The number of Korean banks and the number of like Japanese banks that I've spoken to will blow your mind. Basically, they're all trying to see that, hey, America has this amazing investor base. They have 300 million people. We're the richest country in the world. How can we enter these markets through on-chain rails so that more users can come and access our products or perhaps purchase them? Yeah. That's why tokenization, I think, it has taken on so much more momentum in countries like Korea and abroad.
Yeah. Do you ultimately see on-chain finance then kind of creating just one big global market where it's not like U.S. market, Asian markets, Latin markets, but just markets, and like we could trade wherever and everywhere?
That's the dream, right? So my hot take is yes, like of course that's what all of us want, but unfortunately that's not what we're gonna get. What we're gonna get is we will get global markets, but we will get certain flavors of that market in different countries. A good example is like messaging apps, right? You've probably traveled abroad.
Yes, I have.
In America, we use things like Facebook Messenger or text messaging. But if you go to Europe, everyone's just on WhatsApp. If you go to Russia, people are on things like Telegram and Signal. So it really depends. But they're doing the same function. They're all messaging apps. Maybe it's not the greatest analogy, but I see markets operating in a similar way where, yes, everyone is texting or everyone is tokenizing.
Right.
But perhaps there's a slightly different flavor or UI by which they're doing it that's more adhering to the Japanese market or the Korean market or the American market.
Yes. I mean, there's a lot of discussion today around tokenization, stablecoins, as we've touched on, and on-chain finance. Which use cases do you think are going to generate the most serious commercial interest from organizations you're speaking with?
I think right now, without a doubt, bond, that bond needs to earn a yield. There needs to be a revenue mechanism. So that's why I think a lot of people are driving towards that direction, because there's a proven way to capitalize on a business. But I think they all work in tandem, right? When you tokenize, you also need to bring something on chain. So it's like, it's hard to sort of say like one will succeed with the other. I think they all sort of go up in tandem.
Mm-hmm. How has the vision for Injective changed over the years as like, you know, we're starting to get more quote unquote serious players into the space? Like your on-chain finance mission probably is going to accelerate a lot more and become like more deeply embedded within the traditional markets, right?
Yeah, it's a great question. I think when we first started, and this is back in 2018, it was really the Wild West. Let's be honest, we were not really thinking about regulations. We were not really thinking about
you're just like fixing the financial systems.
Exactly.
Honestly. Yeah.
We're just building for users, and we're building for everyday consumers. Now we've gotten to a point where, hey, this stuff doesn't have to be the Wild West. We don't need to work in the shadows. We can come out and work hand in hand with regulators, with government officials, because they're starting to understand the technology. So what's really changed is us becoming more serious and realizing that, hey, the tech we built is so amazing, why not share it with the rest of the world and help modernize the rest of the world? It's almost like how, and this is the analogy everyone likes to use, when you think about the internet, initially it was just used for bad things, right? Without getting into details like gambling, etc. Over time, the internet has been used for everything. So I think blockchains is in this interesting position now where, yes, the people who wanted it to be the Wild West forever are not going to be very happy about this, but it will change the world, and you will see that a lot more serious people or institutions are now engaging with this tech that they wouldn't have before because they thought it was too wild before.
Yeah. What about the next wave of builders in the Injective ecosystem?
Yeah.
What would that look like? Is it going to be these classic zany crypto developers, or is it going to be a mix of that plus insert your answer?
Yeah, so my take here is, and if you looked at developer trends over the last 2 years, it goes without a doubt. A lot of developer mindshare and talent has just gone off into AI. Like so you don't really get cutting edge developers in crypto as much as before. And this is obviously bleak. So we realized this about like a year and a half ago. Like, hey, all these developers are leaving crypto as a whole, right? Like, it doesn't matter what chain you're on, Ethereum, Solana, Injective, like they are not interested in crypto. Because why would you be? Like, AI is way more cutting edge. So I think the class of developers we are trying to onboard and that are coming here are the ones that want to build at the intersection of crypto and AI, where they might want to build agentic applications or AI applications, but on blockchain rails, or have payments done. We've released a lot of tool sets or toolkits to help with that, like the Agent SDK recently, or Dap Builder, where you literally go in, write in a prompt, and it builds an app for you. So I think that's where the next wave of builders come. No one is interested in building just a crypto native app. People are interested in saying, hey, how can I like take AI and embed it into crypto, because that to me is more valuable. How can we have payments on crypto run with AI agents? And I think a lot of attention is being put there for good reason, because a lot of payments are done at such speeds that only AI can really help you scale, not a normal human. So I think that's where the next class of builders comes.
Yeah, 100%. And I'm excited to see what develops there. But Mirza, thank you so much for sitting down with me today and having us at your event.
Absolutely. Thank you so much.
Yeah.
And welcome back to the Injective Summit, guys. Again, I'm Gerald Gallagher, host of Crypto in America, and I'm here with Steve McClure, CEO and founder of Canary Capital. Steve, how's it going?
It's great, Gerald. Good to see you.
Yeah, we're out here baking a little bit.
A little bit.
You know, it's not as big of a meltdown as the market. I know we're going to jump into that. Tell our audience a bit more about what Canary Capital is and your background.
Yeah, so look, Canary Capital, we're primarily an ETF company focusing on altcoin ETFs that mainly focus on tokenization, real world assets. That's an area that we're pretty passionate about. So we've been focusing on that for the last year. We also have a hedge fund business, so we're getting private money as well. My background is way back in the day, traditional finance, running bond funds and other funds, bond trading. And I got into crypto 10 years ago.
Yeah. And so you guys, we're going to get into the markets, but you guys have something interesting cooking in the injective space, right? Can you tell me a little bit more about that?
Yeah, so we filed for a injective ETF. And one of the significant things that happened there is they did get futures listed a few months ago. So as you know, the generic listing standards allow for you to launch a crypto ETF as long as there's a futures market for at least 6 months. So we're just, the clock is ticking.
Yeah.
So hopefully we can get it launched this year.
Yeah, and tell me a little bit more, because you have a background from that active trading environment. Obviously, ETFs are maybe thought of as more of like a passive asset class. You were on stage earlier talking about digital asset treasury companies. How do you see like the on-chain kind of financial world coming together with all these different sort of instruments?
Yeah, so and my background was a lot more active management, even within ETFs. I launched some of the first active bond ETFs way back in the day. But I'm really seeing a lot of interesting things happening. DATs were a fun experiment. I think a few will last. I think most won't. We're watching those very closely. We can get into more on that later, but and then as far as ETFs go, it's giving audiences, not just retail, but institutional audiences and financial advisors, the ability to invest in digital assets through a vehicle that they're used to.
Yeah.
So again, we're seeing a lot of things there, and then on-chain is super interesting right now. It's the whole reason I got into digital assets 10 years ago. I saw inefficiencies in the bond market, and I want to see the ability to trade bonds or any other assets that settle very late to settle instantly. And I think that'll be a big bolster to financial services.
Yeah. So let's talk a little bit about what's going on in the market right now. I think Bitcoin ETFs peaked around maybe about 115 billion last year in 2025. We've seen a lot of outflows recently. We're seeing people kind of cut price targets. Where do you think we are in terms of the market cycle, this institutional adoption we're talking about, and like what's happening with Bitcoin specifically?
Yeah, so Bitcoin and the market in general, we're very, very close to a bottom right now. And seasonality, it makes a lot of sense. I believe that there's a bit of a bolster at the moment. There's some exciting things happening with legislation, with the current administration, that's really going to cause crypto prices to rise again, hopefully soon.
Yeah.
My expectation is that we're probably getting a little bump here. We'll probably go back down until midterm elections are over, and then we go right into the next 4-year cycle and price straight up for 3 years.
There you go. So yeah, still bullish. Tell me more about like that thesis, because there's a lot of thoughts on, are we still in a 4-year cycle?
Yeah.
What miners are doing, how the economics of Bitcoin are working, and how that maybe also affects like other altcoins. Like what's your view on sort of why we may be bottoming out, and like what other influences could you see driving price?
Yeah, the reality is Bitcoin is still a major part of the total crypto market cap. So what happens in Bitcoin is going to affect the rest of digital assets. It's not going to be like that forever, but it's like that now. And mining activity, the 4-year cycle and halving is still relevant. Every halving, it will be less and less relevant. And the reason I say that is when each halving happens, it'll have a smaller effect on price from a percentage standpoint. It's also the law of large numbers. So it's why we didn't see a big blow off top last year. It's why we didn't see a drastic drawdown this year. I mean, we had a drawdown, but it's 50%. That's not crazy.
Yeah, been here before. Not our first time. Yeah,
exactly.
Tell me more about that kind of leveling out, because obviously I think one of the underlying things that people are looking for as institutions come is that lower amount of volatility, right? There's a much bigger pool to kind of absorb some of the shocks. How do you see that going? Like, are we we've got Vanguard ETFs now. Obviously, you guys are launching a lot of products outside of Bitcoin. How does all that kind of come together as far as the institutions coming in and stabilizing this environment?
Yeah, so I mean, even when I was an institutional investor in more traditional assets, those run in cycles as well, right? So there's usually a 7 to 10 year economic cycle that everything falls into. There's annual cycles, pension funds, insurance companies, even private wealth funds. There are times of the year that they're allocating capital, and then there's times of the year where they're not. And that has a profound impact on cycles, even on an annual basis. So, traditional investors are used to cycles. It's just understanding what this cycle means and what this cycle does, right? So, again, this is on a bit of a 4-year cycle. But I think what's going to be interesting in this cycle is that I think Bitcoin is going to have less and less of effect on the entire market. Price appreciation is probably going to be a lot less than people think it's going to be. I'm hearing numbers 250,000, 1 million in this cycle. I'm probably looking at 150, 200 max. And one of the reasons for that is a lot of clarity around regulations that have happened in the last 2 years, which has caused the industry to move into stablecoins. So all the things that Bitcoin was going to do, right? Yeah. Transaction, store of value, people are using stablecoins for that.
Yeah.
And the underlying is U.S. Treasuries. Whether or not there's going to be a yield or not, that's going to be found out really soon in the with the Clarity Act. But the reality is most retail investors that are holding crypto are actually now holding stable coins.
Yeah. Yeah. What do you think? I mean, we've talked about Bitcoin. We talked about the Injective kind of staked ETF, but is the theory here really like a rising tide lifts all boats, or like when altcoin season? Like what's coming back there?
Well, I'm hoping that altcoin season comes back a little earlier than a normal cycle. It's usually what happens is Bitcoin rises for a year, then altcoins come in, and then you've got a kind of a blow off top in Bitcoin, and altcoins come after that, and then they all go down. There's a big separation right now because of the current administration, because of legislation that's been passed in the last 2 years, and because of the new SEC under Atkins, where securitization is an extremely important part of the crypto universe. So the projects that are doing the best in tokenization of real world assets, or moving stable coins, or building stable coins that are interesting, because not all are built the same, I do believe that those projects and the tokens tied to them are going to be the biggest benefactor in this cycle. And then the ones that don't have that probably won't. So my expectation is some of those tokens will start rising early, and will outperform Bitcoin and all the other assets.
Yeah, so we talked a bit about, you mentioned Chair Atkins at the SEC, we talked about GLS. There's a lot going on the regulatory side of the agencies. Is your view, do we need clarity to make all this happen, or how do you see that playing out?
Yeah, so a really good question, because honestly, for my business and a lot of other businesses in crypto, we don't care.
You have clarity. Yeah, you're good.
We already have clarity.
Yeah,
We're good.
Yeah.
I do think it's important for some aspects of the business. It's largely symbolic. So even if it doesn't pass, I don't think it really matters. And then the most interesting piece, and this is where all the fighting is whether or not stablecoin should be able to deliver a yield. Mm-hmm. And most of the people in the crypto side of things are like, yeah, absolutely, it should. And my argument is different. My argument is, look, you've got certain protections under the 40 Act. You can launch a stable coin that's in a 40 Act wrapper. You register with the SEC. It's very easy to do. And those are the ones that should be able to distribute yield. I don't believe that USDC and Tether should be able to deliver a yield based on buying and trading and holding bonds that create that yield.
Yeah.
So that makes it a security.
Yeah. No, it makes sense. I know we're going to have a lot of other really interesting takes here, but thank you so much, Steve, for joining me, and appreciate it.
Awesome. Thanks for having me.
Thanks, guys.
Okay. Ooh, so sorry. I almost got taken out. Well, before we dive into the rest of today's programming, we have a quick message from New York Senator Kirsten Gillibrand, who couldn't make it, unfortunately, but she left us with a few nuggets of wisdom about the state of crypto. So I'll let her take it away, Senator.
Hello, I'm Senator Kirsten Gillibrand, and I'm excited to welcome you to our nation's capital for a critical conversation on the future of blockchain regulation. Without clear bipartisan regulation of the digital asset industry, the U.S. risks falling behind its adversaries and allowing bad actors to take advantage of consumers. That's why my colleagues and I have approached our work with one simple goal: to create common sense rules that protect consumers and ensure the United States remains the global leader in financial innovation. We passed the Genius Act to provide rules of the road for payment stablecoins, and we must now bring the same clarity to market structure treatment. That's how the U.S. will remain the best place in the world to build, invest, and use digital assets responsibly. Thank you for being here today and for committing to build a future that keeps innovation here at home.
You're very welcome, Senator. I'm very happy to be here for you. Now, everyone, let's gather in. Let's take a seat for the next fireside chat. I get paid by how many people are sitting up here, so if you could help me out and do me a favor and come up to the front. I'm going to introduce one of the most famous luminaries of the crypto market in Eleanor Terrett, who hosts a show called Crypto in America. She is probably the poster woman of all things regulatory and policy, being joined by an equally as a luminary figure for a fireside chat. Welcome up stage, come on. Introduce the fireside.
Thank you, Frank. With my esteemed panel partner, Sunayna.
Thanks for setting that low bar.
Yeah, for real. Hey, everyone. Happy afternoon. How was the food? Good, right? Yeah.
Parasite free.
I was
I
cautious.
hope you all took out the lettuce.
Oh my goodness, yes. I did take out the lettuce because someone else at the table did, and I was like, I'm going to do it too. Anyway, Sunayna, welcome.
Thank you.
Yeah, so we've known each other for, I think, a little bit under a year at this point. We met.
She got me in trouble. That's how we met.
I did get her in trouble for,
Which doesn't take a lot, by the way.
I tried to schedule something at the Fed, and it wasn't like through the right channels, and I had to go through the public affairs office, and yeah, the public affairs guy got mad at us. But anyway, it was at SALT last year, which, gosh, coming up on a year, SALT, Wyoming. But let's go back to, that time. So you were Chief Innovation Officer at the Fed, where you were for 5 years. And we had a little discussion before the panel. I think you and I have had similar career paths in that we have kind of landed in our careers randomly. There was sort of no planning. It was kind of just like, okay, here we are, and we're just going to grab the bull by the horns and go. And I'm curious how you kind of became CIO of the Federal Reserve. How did you get onto that path, and why did you stay? And kind of just give us a breakdown. We'll start there.
Oh, okay. Well, thank you for having me. Ellie and I like to make good trouble together, so we're going to try and do that here. I like to say serendipity. It sounds fancier than random.
Yes.
So I joke that before I joined the Fed, I pretty much spent my entire career fighting with the Fed. So I was in private sector all of my career, fintech, crypto, capital markets. Had no plan about working at the Fed. In fact, as I said, I spent all my time dunking on the Fed because they were not embracing crypto and stable coins because they were all about central bank digital currency. I was no. So anyways, had zero plans. And serendipitously, I got a call one day from an executive recruiter saying, I'm calling on behalf of the Fed. They're creating this new role, and they would like to talk to you. I actually thought one of my Bitcoin bro friends was pulling a prank on me. I'm like, yeah, sure, the Fed wants to talk to me. Anyways, that's how the journey started. I started from a mindset of innovation, central banking, isn't that like an oxymoron? To then spending 5 years at the Fed, building an entire innovation practice. And what I would submit now is not only innovation at a central bank, actually public sector at large, not an oxymoron, I would say it's highly imperative that public institutions embrace and activate innovation just as much as it's expected of private institutions, right? We always look at private institutions and say, hey, you got to keep up, like, you got to be innovating, but we always cut slack. Oh yeah, but public institutions, they're slow, they're behind. We cannot cut them that slack, and we can talk about why a little bit more. So yeah.
How did you do it? So you got there and you created this program, but you started from scratch. I mean, was there pushback when you got there? Were they kind of like, who is this woman trying to come in and push us into the 21st century? I mean, what was that like?
Pushback. They rolled the green carpet.
Yeah,
no, easy peasy. No, I'm just kidding. I mean, listen, I went into it not knowing, honestly, what I was doing. The reason ultimately why I said yes to it, they really didn't know what they wanted, other than they were creating this brand new role. And the interesting part of it was it wasn't tethered to any one reserve bank or the board. It was like working with the entire solar system. As I joke, the Central Bank of the United States is not at all central. They've known DeFi since 1913. So it was working with the entire system, and I just wanted to serve my country, so I'm like, fine, I will do this, but it was like a high beta trade. Either it was gonna work or wouldn't work. Well, I stayed 5 years. So going in, I knew I had to go in with a lot of humility, right? Like everybody at the Fed is highly tenured. They've all been there like 10, 20 years. So I was coming from industry. I didn't know anyone. Not only was I coming from industry, I was coming from like a grubby part of industry they didn't like, crypto, right? So I just had to go in with a high degree of humility, but ultimately help them recognize that the risk of not doing was starting to be greater than the risk of doing, right? And part of it is, number one, the volume, the variety, and velocity of technologies that were just coming at them and just happening, are unfathomable. And the Fed, both in embracing and applying that technology, but also as a policymaker, how can apathy be an option, right? Yes, we're risk averse. We're a large institution with a very important mandate. Break things and ask for forgiveness is not gonna work, right? And I would never propose that. However, not doing anything is not an option. So it's like meeting them, meeting them where they are and bringing them where they need to go. But yeah, no, listen, I'm not exactly at a central bank to be working at a central, not at a central casting to be working at a central bank, and I give the Fed a lot of credit for totally going out of their comfort zone. But it's like meeting them where they are. And the last thing I would say is putting a lot of quick wins, right? Don't go for the big things right away. It was really putting a lot of quick wins in the beginning and then tackling the heavy stuff. And the last thing I'll say is the way we structured our team was, think of us as the speedboat within an aircraft carrier. Because what I knew right away was the Fed is an aircraft carrier, and even at full throttle, it is only going to move at a certain pace. So I'm not going to get this aircraft carrier to move as fast as I would like it to. But what I can do is launch a bunch of speedboats that can really go out there and interrogate these frontier capabilities in the context of the central bank, and then have them ship those wins and then scale it within the aircraft carrier. And that model really helped us ship a lot of wins, scale it, and then make the presidents and the governors look good, and that always helps.
And this was 2020 that you went
into
the
I
Fed?
started, it's 2020, early 2023 I started.
Oh, early 2023, okay. So this was right around the time of, I'd say, Operation Choke Point 2.0. So that's a term that the crypto industry is very familiar with, sort of what has been described now. And I think, in Senate Banking Committee hearings, the president himself has talked about the system-wide debanking of the crypto industry. And I guess my question to you is kind of like, what was it like going in at that time to a Fed that, on the outside to the crypto industry really felt very unfriendly and really didn't seem like it wanted to innovate very much? Maybe it was a different feel on the inside, but what was that sort of contrast like? I mean, it sounds like it maybe wasn't that way on the inside, but how was that for you?
Oh no, it was jarring and depressing. And I tried to quit many days. Actually, it was a lot of people I know and trust and respect in the crypto industry who are like, no, you cannot leave, right? Because if the change happens from within, right? I think you know Governor Waller really well, and we both laugh that in the last administration, they weren't just trying to drive crypto out of DC, they were trying to drive people like him and me and others, like a small group of us out of DC. And we're like, no, we're not leaving. We're going to stick it out and we're going to try what we can do. But no, the headwinds were very, very strong. And the other part of it at the Fed that was also important is like the hands-on keys component was very important to me, right? Like, again, for those of you who've been in crypto long enough know, some of the early guidance and rules from regulators, including the Fed, but all regulators, was like, hello, have you used a MetaMask wallet? Like, have you launched a protocol? Like, it was very evident that you haven't touched the technology. And I'm very adamant that as a policymaker, like, how do you put out a policy if you've never touched a policy? Like, you can't admire technology, you've got to activate it. To me, it's like, you want to run a marathon? Okay, what are you going to sit watch YouTube videos of him running a marathon? Like, sorry. No, you're going to have to lace up your shoes and get out there. So I think with crypto, that was such a downfall. And I think that represented itself in that dark period because a lot of opinions and, shady stuff and FUD was being rendered by people who had never actually touched the technology. And with AI, I'm happy to say at the Fed, completely different posture. And I think even with other policymakers where they're using the technology, understanding the technology, even applying the technology, which I am bullish you will see in how they render policy. Doesn't mean the industry is going to like everything, but it will demonstrate a level of pragmatism and prudence.
Why is it so different for AI than it was for crypto?
I think one difference is AI is something that touches everyone, obviously, as consumers. So, it's relatable in that way. Crypto obviously wasn't something that touched every normie. It was a very small subset of users. So I think there's that. Second, I would, like to think that a hard lesson was learned. And for this, there was at least at the Fed, there was a conscious effort. ChatGPT came out 2022. By January 2023, we had activated, at that time it was really chat, models. We even activated Hugging Face for those developers in the room. Again, now we did it in a safe, quarantined way, away from all the important systems, but and it was for everybody, right? And no permission needed. That's the other thing in these big organizations. There's such permission-seeking organizations. It's like you feel like you need 10 OKs to move a piece of paper, and that's antithesis to innovation. So that was one of the biggest culture changes we had to make. It's like most of the decisions we make are two-way door decisions. Just make the decision. If it goes sideways, I got your back, and we can always pull it back. There's very few decisions that are one-way door decisions, as Bezos says, and those are consequential. And yes, those don't go rogue. We have to do it together. I think as that part of the culture change, that's when we started to see the metabolism really start to change. And with AI, because that culture had already been set, we started to reap the benefits.
I want to get into something that you worked on right before you left, which was the payment accounts or the skinny master accounts, and something that you and Governor Waller worked on together. It's being worked on right now, potential rollout by the end of the year, we'll see. But can you kind of just give us an overview of actually what the goal was with that? Because you mentioned hard access to the payment system, right? It's kind of like, you have to kind of be a member of the club to be a member of the club. This would make it a little bit easier for these companies in crypto, and not just crypto, but fintechs and innovative companies to be able to get access to the payment system. And I'll let you break it down, but is that essentially what the feeling was there? So banks aren't just the only ones in the club?
I think you answered my question. And it's not hypothetical. Kraken got one.
Well, they haven't implemented yet, right?
Yeah. No, I think like you want a job at the Fed. You want my job? No, and listen, Governor Waller gets, for those of you who've had a chance to meet him and do get a chance to meet him, he's very accessible. And I can tell you, like he gets, most of the credit. Like his zeal for innovation, especially in payments, is, just like, can't compare it. And having a leader like that by your side, it's any innovator's, dream come true. But exactly, and listen, everything from an innovation perspective, we definitely try to, embrace is like start with the gnarly problem. Listen, there's a reason innovation gets a bad rap, right? It's a bunch of weird people in a lab chasing some shiny object that doesn't deliver anything other than zombie projects that never die. So when you start things, you really want to say, what is that gnarly problem you're trying to solve? Why does it need to be solved? Like, not all problems need to be solved, right? And then why are we uniquely qualified to solve it? And that third question is very important, and it's especially important, as you know, to Governor Waller, because he's a very big believer that the market should solve as many problems as possible, and we should stay out of their way, right? So by the time we got to solving it, we did a lot of work, including at the last SALT. We talked to so many builders, individually, in groups, to say, why is it that you need a master account? Like, break it down for me, right? We had a lot of spicy arguments, spicy conversation. We did design thinking, whiteboarding, like to really get to the crux of what is that problem you're trying to solve. And then, a lot of steps led to, okay, what is realistically the solution that can be delivered that led to Skinny. I was told not to call it Skinny, but whatever. To Skinny, and and
catchy,
right? And I also give Governor Waller kudos. Like, he did something that's usually not done. He put a shot clock on it. He said, no, this is not going to take 20 years. I'm giving it 12 to 18 months, and we're going to get her done, right? And I'm going to be cheering for them. But that really was the essence of it. About there's a problem, let's get to the bottom of it. And another unique thing. Progress over perfection, and that is okay. But for the Fed, oh my God, that is opposite to everything they do. Because in a central bank, but every regulator, until something is perfect, you don't ship it. And with this, we said, when we ship the Skinny, and we talked to a lot of the folks that will be potential users, it is not going to be perfect, it is not going to be pretty, but it'll be shipped, and we will make it better as we go along. That is opposite of anything, the Fed ever does. So a lot of kudos again, to Governor Waller for applying that, startup mindset.
Yeah, he's breaking the Fed. Good trouble, I think you said in the beginning.
Good trouble.
Yeah. Let's talk about stablecoins. I mean, the Genius anniversary is this week, and I think no one can argue here, it really opened up the payments innovation industry, right? I mean, just stablecoins are the topic of the year. When it comes to the Fed, though, I mean, do you see them taking sort of a leaf out of the payment modernization book, as it were? I mean, will the Fed ever get on, payment rails, blockchain settlements, and stablecoins? I mean, that's probably a loaded question, probably something that you can't answer, but how do you see sort of the Fed, taking a leaf out of this modernization page that crypto kind of brought it, and they're leaning into it now with some of these innovations that you yourself have worked on?
Well, I don't work at the Fed anymore, so I don't.
You don't. But you can.
I have all kinds of opinions. First of all, congrats to everybody. Stables are real, and it's a 1-year anniversary. I think what I would say, without any precision, is one of the proudest things I was able to do is we hired about 12 to 15 engineers from the tech and crypto space. The only good thing that came out of that FTX disaster was I was able to attract some really baller engineers during that downfall and say, come serve your country, come work at the Fed. I used to call it FedCorp, Peace Corps for the Federal Reserve, to say, bring those skills, the smart contract, tokenization, but apply it to the payment rails that the Fed runs for the world, right? Listen, we all love to dunk on these old rails, but they clear trillions and trillions and trillions and trillions and trillions of dollars every day, and you don't hear a peep, right? And it gives the US a lot of soft power behind the scenes. That's one of the reasons why the dollar is the reserve currency, right? But yes, you got to keep leveling them up, right? You can't get complacent. So we brought in like that expertise and crypto technology, and now we're applying it to strengthen and level up existing rails. So how that connects to stables. Now, when Genius was happening, one of the things we looked at was how will fiat rails, which the Fed runs, so it's we have responsibility and accountability, and stables, which obviously run on DeFi rails, is there intersectionality, and is there a role for the Fed? And we talked to a lot of industry participants, and one of the use cases was, hey, if I'm a CFO at a company and I hold stables and I hold fiat and I want to seamlessly go back and forth, again, does the Fed have a role? Because we don't want to get in the way. Can the market solve this problem? So some of the work we did, and I know Governor Waller's talked to you about this, is we did some work with HTLC, one of the smart contracts, to say how do we make that process super simple, right? So money can move very effortlessly. But again, we don't want to build it if the market can build it and the market can solve it. So that's really the process, at least my team and I went through, is we look at the full life cycle of a transaction, full life cycle of a process, and say, where will it touch the central bank? And are we becoming an unnecessary clog? And if we are, how do we fix it?
Central bank digital currencies.
We killed it,
Your
which
favorite.
is the best thing I got to do with Governor Waller.
Did you?
I mean, no one's working on it, and it's in the bill, right? We
Well,
just
that's
got to
what
get
I was going to say.
signed.
Was anyone actually working on it inside the Fed, to your knowledge?
No, we killed it.
No. Okay, good to know. Should the Fed be working on kind of, digital currency in your view? Is there room for maybe a wholesale CBDC, if not
What's
a retail
the problem
CBDC?
that needs to be solved? Tell me the problem. Give me a problem statement, and then we will figure out what the solution is. I used to go to the BIS for a lot of meetings, and they love CBDC, and that's fine. Europe is doing their digital euro, and listen, the digital euro, there is a concrete problem they're trying to solve, right? And good on them. Show me a cogent problem statement for which the solution and the only absolute solution is a wholesale CBDC, and I'm happy to talk about it. Listen, I have no religion on, people are like, oh, stables or tokenized deposit. I don't care. Let the customer decide. Let the marketplace decide, right? I come from a place, I don't know, maybe I read too much Ayn Rand. I come from a place of, great. If you think your product is great, put it out there. Let the customer decide. But with CBDC, I haven't seen a very cogent use case that shows me that the only solution is a CBDC. But if there is, happy to have a conversation.
And then on AI, I know it's something you've been super.
I've been driving her crazy with all of my ideas.
She's like,
she's
AI,
being very
AI,
kind.
AI. What's your long-term thesis on AI?
I have many.
When it comes to, I guess, the financial, I would say the Fed, but I feel like we don't want to talk about the Fed too much because you're not there anymore. You're like, why are you asking me all these Fed questions when I'm not there anymore? I'm assuming the Fed's going to be using AI to as part of its modernization plans. But in terms of updating the financial system, as it were, in the U.S., what is AI's role? What are we going to see there? Is it agentic payments? Is that really sort of the use case there, or is there broader? What are you seeing?
I will actually answer the Fed question on this one. One of the things I'm super proud of our teams at the Fed and the leadership is we very early on decided that the Fed was actually a target-rich environment for the application of AI, and not just Gen AI. We looked at the entire AI stack. Again, you start with a problem statement, and if the answer is RPA, great. If the answer is Gen AI, great. If the answer is vintage AI, I call it vintage AI. It's not. But we apply the right solution. So by the time I left, all developers at the Fed were AI enabled. Every developer's IDE was connected to Bedrock, right? Mm-hmm. In fact, in 2026, every employee at the Fed had AI in their employee goals. I'm very fond of the Charlie Munger quote, show me your incentives and I will predict your behaviors and outcomes. So when it is in my performance goals, that I have to, be, and again, we were specific about, again, it wasn't like grand goals. It was you have to be AI trained, you have to apply AI in your role in this way. Everybody from the analyst all the way to governor, and that kind of shows the Fed's commitment. Like if it's in your employee goal, even if you don't want to do it, you're going to do it.
Are we talking about ChatGPT usage, or are we talking about like vibe coding?
Well, we used most of our AI capabilities through our cloud providers and through our vendors. We built certain models for some, very proprietary work. But yeah, everybody used AI, like the developers used for coding. But we used it in all kinds of other use cases. But all to say, it was pervasive, and people had permission to use it in their day-to-day work. Now, again, in a guardrailed way, and with all the cyber and risk and compliance wrappers that it required, nobody was allowed to just plug right into the ChatGPT subscription that you and I have. Let me just be very clear, right? So there was a very safe and secure way in how that was brought into, just like it's brought into all the other organizations. So that's and with Agentic, that was actually one of the big things that we were starting to look at. How should we think about the intersection of payments and AI? I mean, this is my personal thesis, nothing to do with the Fed. I mean, I'm very bullish, as you know, and I'm bullish because if agentic commerce manifests the way that we all think that it will, and it's not going to happen right away. It'll probably take like a good decade, just like e-commerce. It's going to make e-commerce look like a joke, right? Because now this is machine to machine. The volume and velocity of payments will supersede anything that we've ever seen. But it's going to need a substrate for payments. I love FedNow. I heart you, FedNow. But there's no payment rail that's going to support that efficiency or that volume or that velocity of payments. And we are underestimating the fact that we have a regulated US dollar stablecoin approved and just sitting there. And for those of you who know S-curves, so as the S-curve of AI and agentic are just coming, the S-curve of stablecoins are just coming. And again, my thesis is they're lined up perfectly for that Cambrian moment. I mean, like Uber just didn't happen, right? Uber happened because location technology, mobile technology, a bunch of things were ready at the right moment and connected. And that's why I'm bullish about agentic commerce. And if it's run on stable coins that are US backed, hey, that's dollarization on steroids, which means people are clamoring for US treasuries, which means the dollar is further strengthened. Sorry, everything comes back to, the mighty dollar. But that means, AI policy has to be done, again, in a prudent and pragmatic way. So that's where I see the intersectionality of AI policy connected to a lot of things that are happening around payments, around financial infrastructure, things that we have to refine and redo with fraud, because fraud is going to completely collapse in the world of agentic commerce, because today when a machine conducts a transaction, it's fraud. Well, in the future, when her agents and my agents are out there buying shoes for us or ETFs or God knows what, how are you going to know what's a real agent doing something for Ellie and what's a North Korean bot that really is trying to attack you? So we're going to have to redesign fraud. We're going to have to rethink identity, which means for all the builders in the room, ideas for startups. So
there you go. Sunayna, what's your next move?
I don't know. Does anyone want to hire me? No, I'm kidding.
Here we go.
No,
that's why I asked that question.
I promised my family I was gonna take a break, and they all bet on probably on Kalshi that I wouldn't, and they're probably making a lot of money. I'm helping out with some AI policy stuff right now, and I am figuring out what I want to do next. My cheekiness aside, I do welcome ideas and advice, but I haven't landed on anything concrete yet.
Okay, well.
And I think we're getting the signal. Thanks for letting me.
Thank you, Sunayna. Thanks, everybody, for listening.
Amazing. Eleanor, great job. I wasn't giving you any signal to wrap up. I was just stretching my arm. You know? That was fantastic. Yeah, come back up, you know? I want to hear about your next career move, you know? What you got to tell people, you have to tell people what your strengths and weaknesses are, right? Just like a job interview, right? Yeah, it can be. I mean, small fee, 1 Bitcoin. That's all I need. So speaking of Bitcoin, we're at a crypto conference. And the next panel is going to talk about the undergirdings of the market structure, right? The capital markets in crypto were brought to its knees last October. And 2 years ago, right, we suffered a massive credit crunch that wiped out a lot of liquidity from the market in the wake of FTX. So how do we rebuild from there? What infrastructure is needed? What pipe and plumbing do we need to really enable Wall Street to fully on board? And leading that conversation is going to be Brandon Gross of Injective. He's leading research. I'll let him come up and welcome the rest of the panel, but some great folks from across the industry. Hope you enjoy.
Thank you, Frank. I'll forgive that mispronunciation of my last name. It happens a lot. It's Goss.
Goss.
It's all right. It's all right. Thank you all for joining me. I'm excited for this panel. Just to kick things off, I want to give everyone a chance to introduce themselves to the audience. So work left to right.
Yeah. Whoa. Hi, everybody. Charlie Durkin. I'm a Principal Solutions Lead at Chainlink. Prior to joining, I spent a decade at Citigroup, both investment banking and debt capital markets, as well as a product manager on the capital markets technology team.
Max Barres, Head of Lending at Galaxy Digital. Been with Galaxy Digital for the last 4.5 years.
Hello, everyone. I am Stacy Cook. I'm the Senior Director of Global Risk and Regulatory Compliance at MoonPay. Prior to that, I spent time at Robinhood Crypto.
Awesome. Thank you very much. Okay, today we're talking about on-chain global finance. So sort of want to put it back to you guys. What part of the on-chain financial stack do you own? And give us a little bit about like what's the hardest problem right now that you're facing. I know you all come from kind of different verticals.
Yeah, so Chainlink is best thought of as the connectivity middleware when it comes to blockchains. Blockchains are very good at immutable record keeping, but they're not good at communicating with each other or off-chain systems. So Chainlink brings data on-chain and then helps blockchains communicate with each other. And then I think the biggest problem or the hardest problem being solved right now is standardization in the marketplace. No bank wants to have to connect to 10 different blockchains 10 different ways.
Well, boy, do I have a product for you. Galaxy actually had a pretty big week in terms of our integration with on-chain finance. We launched on, I think, Tuesday, the Galaxy on-chain financing rate. We're calling it Gopher. It's a play on SOFR. And what that does is you can post Bitcoin native directly to Galaxy. We'll take it. We'll do the operational complexity of wrapping it on your behalf, putting it to the different lending protocols. To start, we're going with Aave, Morpho, Spark, and Camino. With that, it will take a weighted average based on where we're borrowing from, and we pass it back through to the users. In addition to that, we did another announcement. I think it was yesterday, but the days are sort of blurring, with Grove Finance, who we partnered with in the past, where we launched a new warehouse line where you can come to Galaxy, you can post your collateral directly to Galaxy, you can put it in tri-party, so non-rehypothecated, and you can then get us to lend to you, where then we're getting our back leverage from Grove, where they have a very unique setup with the Sky ecosystem, so developing those deep partnerships across all the different places on chain, but bringing that digitally native and institutional feel to everything that your original question was talking about.
Yep.
All right, so I bring a completely different lens. I don't know all the lingo. I'm not really good at saying all the lingo. What I do is on the back end. So when it comes to on-chain, blockchain, we're really trying to make sure that we're providing a safe and sound product for our customers. And how does that look like from a risk and compliance perspective? So we want to catch the bad guys, as the Congress people said earlier today, is we want to avoid the bad actors. So how does that look like for MoonPay and for what I do to protect them is we're really trying to understand who is using the blockchain and how we can screen them and how we can follow their journey as they go through MoonPay. That also translates to how do we have this communication and this conversation with our regulators. As we've heard earlier, our regulators are very big on trying to understand crypto in order to regulate it correctly. So compliance's job is to actually sit there and have the conversations with our product folks and our frontline folks and translate it in a way that makes sense not only for us and our policies, but as well as the regulators when they come in to examine us.
Absolutely, yeah. Appreciate that from all of you. Yeah, I want to kick off this conversation over to you, Max. Speaking with crypto credit, I know you just mentioned a couple different announcements. When looking at TradFi and crypto credit, what does TradFi have still that crypto credit is lacking, would you say?
I think the main thing is a liquidity curve. I think right now when you look at crypto credit, one of the things that Galaxy is able to do is we can synthetically create cash by taking our Bitcoin that we have on balance sheet, selling it, and then hedging it with forwards, whether it's the CME or Deribit, and you can effectively synthetically create cash that way. But it gets pretty illiquid outside of 1 to 2 months. And so the majority of crypto-backed loans today are in that 30 to 90 day. And one of the ways that we've been able to provide the extended liquidity to a number of our counterparties is by doing evergreen loans. So it's a symmetrical 30-day recall period. But I do think establishing a 1 year or a 2 year liquidity curve is something that you'll see once institutions start coming in and start trading crypto a little bit more as a part of their mainstream assets. And I think you get a little bit with the ETFs, but I think that you need a little bit more in order to really create that longer duration curve that's associated with Bitcoin.
Yeah,
and all other digital assets, including Injective.
Thank you. Now, that makes total sense to me. And on sort of flipping back to the other side of it, compared to last cycle, what do you think have been the biggest movers and what's been successfully coming on chain in the world of crypto credit and maybe even lending that you've seen that didn't exist in the last cycle?
Everybody's going to want to hear that it's RWAs. I think, and this is probably a really good segue for both of you, RWAs, what it's lacking today is the operational complexity of taking an RWA as collateral. You need to make sure that you have the rails in order to off-ramp any RWA that you take as collateral, which means that you have to then onboard to all the different RWA providers. And so one of the things that I think could get with clarity is market structure around the RWAs can make it a little bit easier so that you can trade in and out of the RWAs as collateral. And I think that's going to be a major unlock, especially when you talk about things like securities, which could be coming on chain, and making sure you have the appropriate rails to trade out of that risk if there's a margin call on a Saturday, Sunday, Christmas, Thanksgiving, 4th of July, et cetera, et cetera.
MoonPay offers exchanges. Swaps.
Charlie?
Yeah, I completely agree, and particularly with the liquidity curve, right? We talk a lot about tokenized assets, but the real catalyst for that needs to be native cash on chain, right? And going back to capital markets, like an issuer can call up Citi tomorrow and rip $2 billion out of the market, no problem, tomorrow, right? You can't do that on chain because the top of the order book, your Vanguards, your Fidelities of the market, don't have their cash natively on chain. They have to then on-ramp it, buy, and then off-ramp. And the economic value prop for just doing that trade isn't immediately obvious right now. And so I think the real catalyst, as you mentioned, is really getting liquidity and then the curve on chain.
I think that's actually why what MoonPay offers, we offer ramps. It sounds like ramps are a big problem for a lot of these companies, and MoonPay offers ramps, exchanges, commerce, and stables, right? So it's how do you get those products to the end customer, right? And what options do you have? And having crypto firms that are able to balance what the customer wants versus what our regulatory obligations are, it's a fine dance, but it's one that MoonPay loves to do.
Yeah, no, I appreciate that. I would say, speaking to what you just mentioned, Stacy, what's the hardest part about when you're moving cross jurisdictions when it comes to compliance and identity? What's the biggest blocker there right now for you?
Well, for myself, there is no blocker. I find it as an opportunity. I actually love trying to solve this problem. MoonPay is licensed. We have our MTLs in 47 states, plus our BIT license. We are also licensed in Europe. We were one of the first companies to obtain our MiCA license. And we're also have licenses in the UK, Jersey, Ireland, Australia. The list goes on and on and on. As part of my team's job and the compliance team's job is to identify how we can do this globally. It can be challenging because there are different requirements, not only for all of our MTLs, but for every region that we are servicing. So we really have to sit down and collaborate with each regional experts. I have amazing teammates, MLROs that actually, I sit down and work side by side with to make sure that we are offering the safest and soundest product to our customer in that region. And what makes sense is to us and to the customer, but also, is it something that has to be isolated from the other regions, or is it something that we can do globally? So we sit there and ask the question, can we have a global policy, or do we have to do regional based? Are we going to be implementing too many rules for certain regions versus not enough rules? So it is, again, to that song and dance, but it's a fun challenge that we deal with every day.
Very interesting, yeah. I'm sure, from the infrastructure stack side, some things maybe we don't even realize is going on is what you're handling there. But I want to flip it over, kind of thinking about institutional, onboarding, and ask you, Charlie, what's it going to take for institutions to sort of move past the proof of concept? I think the last year has been a lot of proof of concept out there. How are we going to get past that and sort of move into blockchain in production, where these things are not just being incubated internally at the large institutions, they're actually being forward deployed and existing in the economy?
Last 10 years really is POC pilot land,
Perhaps,
right?
Yes.
So I'll say that the business argument has been won. Everyone agrees that 24/7 settlement and immutability, these are all great things to have as part of your infrastructure. So I think that from an infrastructure perspective, aside from the liquidity that, again, our friends at MoonPay help solve, I think that one, as I mentioned, is standardization. The fastest way to go die in POC purgatory land is to have a bunch of resources spent connecting to a blockchain and find out that that does not scale to any other blockchain, right? None of these institutions should be spending time and resources on the plumbing. They should be focused on the economic value add of their business workflows, which is where they can continue to make money. I'll say the second one is security. You need defense in depth, because to get a pilot or POC through, you just need approval from an innovation head. If you're going to production, you need the CISO, you need the CRO, you need legal to opine, and if you can't get through a risk committee, then you're not going to be able to get through to production. So you need security that's defense in depth. And I think that finally it's meeting institutions where they're at. My time spent at Citi, I learned a lot about how institutions think about large tech spends, and I think we all have to realize that a rip and replace model doesn't cut it, and you have to meet them where they're working with, and for them that looks like, hey, give us an API endpoint, and now you can connect to any blockchain. So that's some of the work that Chainlink has done in the Chainlink runtime environment area of, keep your existing systems, connect to us, and we'll handle all the on-chain connectivity for you.
Yeah, I think that I resonate with most of that, and I think there's another angle too to consider. I think maybe Stacy can comment on this. Is when you're moving from POC to production, what are some of the things that break down? Right, these are global businesses. If you're operating, trying to have compliant flows across the U.S., across the EU, as well as across Asia, what is the thing that's going to break first? That they're going to run up against when trying to sort of not rip and replace, but at least move closer away from these last decade of POC, right? At some point there has to be an inflection point, but I would imagine you see what breaks first there.
We do, and what we try to say is bring compliance in at the point of ideation, right? Because as Charlie was speaking, there are certain layers of the onion that compliance actually has to peel back. So if we talk about API pings, how do we know that's secure, right? And what are our regulatory obligations for our licenses to make sure that that's safe and sound, right? We don't want to put undue harm on the customer. So we're looking at it from, you know, a policy perspective. What new controls, what new processes are we adding? And is that going to cause issues with our current, you know, regulatory bodies and licenses? But we also have to look at it from a risk perspective. As I own the Global Risk Program, we also need to understand what is our risk tolerance. Every single company in this room is going to have a different risk tolerance. So that's something that we have to really understand is what is the end result for the customer, but what is the end result for the company? And are we in a position where we're comfortable with taking on that risk?
That makes sense to me. So would you say institutions are just slow? Is this a timing thing, or is there something missing that will fix it for them?
Great question.
Yes.
Yes to all the above? Yeah, probably correct.
Yeah, I think from a compliance perspective, it's not that they're slow, they're just trying to be thoughtful and methodical. And, you know, we really want to make sure that we're doing right from a regulatory perspective, and that can be very hard, right? We don't necessarily know how to document it and provide it to the regulators or translate it to the regulators to get them comfortable with it. You know, with a lot of these licenses, you have to submit this stuff way in advance before you actually want to ship. So that takes time, right? And that could potentially slow down an institution from wanting to ship something faster, but also you don't want to make the regulators mad.
Yeah, certainly that on the latter end, I totally understand that. Max, I want to ask you the question. What does good risk and collateral infrastructure look like? We're talking 24/7 markets right here. That's been hit on a couple times. What does that look like in your world?
It's a very broad question, so I'll try and parse it down. I think from our risk practices, if you were to ask our chief risk officer what he cares about most, it is liquidity, liquidity, liquidity. So I think making sure that you have proper asset liability matching practices is incredibly important when you're running a global lending desk. On top of that, you want to make sure that you're taking high quality collateral. And with that, you need to make sure that there's average daily trading volume on the collateral you're taking so that you can trade out of your risk, even if it's, you know, market close for traditional markets and people aren't by the desk. 6, 7, 8 p.m. on a Friday normally seems to be when most margin calls happen. So you need to make sure that you can trade out of the risk. You also need to make sure that you have a 24/7 staff. That's people, tech, all those solutions need to be working together to make sure that you have the ability to margin call your clients when things happen. You have people in place to move the coin when you need to, and that you can trade out of the risk if you need to make sure that you're putting yourself in a position to not take lending losses against a margin loan. I think on top of that, you have many other things that I'm not touching on, but I'll keep it relatively brief for, you know, the topic here.
Yeah, definitely. So, I mean, like when you think about that, right, it's 24/7 market, it sounds like there could be a lot of cost and friction associated with that. And, you know, the whole idea behind moving on chain is the efficiency, the transparency, you know, capital efficiency especially. Are we going to recreate that with this, or?
It's kind of our business's moats today. I think TradFi, it's going to take them a very long time to change that mindset where you have people who are checking their phones 24/7 and making sure that they're in a position to execute on whatever they need to on a Saturday, Sunday, or a holiday. That is the crypto mindset, and it takes a lot of time to really change and conform to that lifestyle.
What is the phrase? Crypto never sleeps. Neither does the risk.
Exactly. On that topic of risk, right, let's just focus on 24/7 markets for a second. Charlie, maybe you want to kick it off, or Stacy, feel free to hop in. How does risk differ in your arenas? Max just described it on his, right? But from the Chainlink side, from the MoonPay side, what does risk look like for 24/7 markets in your world?
Yeah, so I'll speak to the Chainlink side. Risk, when you're dealing with public blockchains, it's the most adversarial environment you can possibly deploy code in. And so, you know, I won't dive into the technical design of our decentralized Oracle network, but in short, it's ensuring that it is impossible for the data to be corrupted when moving cross-chain or put on-chain, right? And so that you can trust, because once something's on a blockchain, it's immutable on there forever. There is no undo button. That's really the real risk of any transaction. It's that you can trust the data that is getting input.
So from a risk perspective and the second line perspective, what I'm looking at is, do we have employees working, right? Or if something hits the fan, are they able to step in immediately? So is somebody going to answer the phone call at 2 a.m.? And then we have to assess whether we need a risk committee, right? Or are we past the point of our tolerance as a company, and how do we achieve that? So, you know, trying to gather all of the members of the risk committee to get a decision on what we need to do, if you need to shut something down, or if you need to halt something, or you need to implement something, what does that look like? And so I'm looking at it as, do we have the right coverage of employees? Luckily, MoonPay is a global company, so we do have all different time zones. But again, you get that 2 a.m. call, what are you going to do, and how are you going to get it done?
Yeah, I think 24/7 markets is definitely a huge unlock, but also it's going to be a huge learning curve. Probably tons of stuff we didn't even think of up here, but I appreciate those answers. Now that's the risk side of things, right? Now thinking about the actual on-chain infrastructure side of things, what do you think is being talked about too much when it comes to bringing global finance on-chain from the infrastructure angle, and what's being overlooked? I pose that question to all of you. Feel free to hop in on that. I know it's broad, but like there's a focus on things, and I think some things might be overlooked.
Yeah, it's less part of the infrastructure stack, and what I feel like is a lot of following the puck in the industry, right? The conversations change month by month, right? Whether we're talking perps or prediction markets, there's always a new novel approach, and these are great products, right? I'm not dismissing that, but something that's overlooked is the massive amount of infrastructure that exists now that isn't necessarily sexy to talk about on a panel, but is incredibly important, right? So we think about moving from pilot to production. The DTCC's collateral app chain moved from pilot to production yesterday. You saw JP Morgan use tokenized Invesco QQQ shares as posted collateral at the CME, right? You're talking GSIB, the world's largest exchange, and the DTCC in production, real value, real assets. This is happening now at the world's largest financial institutions. They're just less, in the Web3 ecosystem, I think less talked about.
I'll keep it relatively brief. I think, to go back to your question of what's overlooked, I think people see on-chain and they see some of the sexy things like the cheap rates and things of that nature. But until you actually start engaging with on-chain and you start engaging on the actual protocols, that's when you start to learn a lot more about things like compliance and risk. So you need to make sure that you're scanning the wallets that are entering the pools. You can connect to something like a Chainalysis or a TRM. You need to make sure that you have alerting in place, things like hypernative. It just starts to get into the nuances of actually how do you interact with on-chain, and that takes time to develop that skill set from a trading standpoint, understanding what are the market opportunities out there, and then going all the way down the stack, risk, compliance, technology, infrastructure, making sure that you're in a position to really hone in on all of the different things that you do on-chain and be able to trade some of the really cool opportunities that originate from the on-chain markets.
I hate to hammer it, but our regulatory obligations, we have a lot. And so I think for that and for MoonPay, we really strive to make sure that isn't overlooked, that you're establishing that culture of compliance and having those discussions, and executive leaders understand that it takes time. It just takes time. We want to ship too. We want to be a business enabler, but we have processes we have to follow. We have things we have to document, and that can happen overnight if we're working 24/7. But it's not something that's overlooked, but it's something that needs to be focused on.
Yeah, definitely. I appreciate that insight. I want to give you all an opportunity, right, focusing on the on-chain infrastructure side of things and looking out 2 years from now, which in our industry is like a decade, but what would you like to see built? I know you hit on liquidity before, but from the infrastructure perspective, what are we missing that we need to have built? What we need people to come on, like from people from your company and the industry at large? What needs to be built in the next 24 months?
I think it's really the orchestration between off-chain and on-chain systems. And so obviously Chainlink has a product for it, but I don't know for that reason if you'll actually see it. This is, again, the back-end infrastructure. What the market will end up seeing is just far more tokenized assets being used in real-life collateral situations. But connecting legacy systems to on-chain systems is just the kind of legwork that we just have to keep pushing through. I will say on a positive note, I know this panel started with a reference to October of last year. My conversations with banks and asset managers didn't change at all with October, right? It's pure infrastructure play. We know that this is for settlement rails, and markets go up and markets go down, right? And so regardless of what is going on with the prices of these assets, this is more efficient and everyone's just marching towards this brave new future.
I would say the two products that I mentioned earlier are really my vision towards what will need to happen to get to 2 years from now more and more adoption. It's the obfuscation away from the complexities of using on-chain. You really want to onboard the next, this is sort of like the buzzword from 2-3 years ago, but you want to onboard the next billion users. How do you do it? You need to make it so they don't even realize that they're using crypto or using blockchain rails. It just has the look and feel of everything that you're doing on Web 2. And the more that we do to obfuscate away the complexities of the on-chain, DeFi, whatever we want to call it, I think the more users are going to come back and want to engage with it because it's just easier.
I'll say global policy unity. I think, in the United States, they're doing a wonderful job with the Clarity Act, trying to unite the regulatory bodies and have, something that should be a little simpler for us to understand and do while catching the bad actors. But also, if you are a global company, that's very hard because all the regulatory bodies across the globe want to do the same thing. And that can be very complex and time-consuming for companies. So seeing these regulatory bodies across the world come together and have the discussion and make sure that they are regulating and documenting things in a manner that's going to make it for crypto firms to ship and to get these products to their customers, in a safe and secure and a timely manner.
Yeah, appreciate that. I think we have time for one more question. One thing I wanted to ask about, we're talking a lot about infrastructure here, right? Broadly, a lot of this infrastructure is supporting real-world assets, and stablecoin obviously was the first one to be brought on chain. I think it's from the technical perspective, the most sort of one-to-one readily doable, and that's why it's been so successful. It's also the start of a lot of, everything else being built out. But as you look at other RWAs come on chain, whether that be equities, stocks, bonds, commodities, real estate, IP, what do you think makes the most sense right now from a technical implementation side of things? What's most difficult? What's up next? Right now, it seems like the industry's trying to do all of it at the same time. So just briefly, where do you think it goes next, and what's the next big one?
I think you started with stable coins that made a lot of sense. Now you're starting to move towards treasuries and money market funds. I'm probably a little biased here, but I think the next natural evolution would be tokenized debt. And you can see that in the form of vaults as back leverage. You could start to see debt products put into some of these different vault infrastructure plays. You could have people come in, you could either vertically tranche it or horizontally tranche it within a vault infrastructure type solution. And that's what I want to see next. What I think is going to be incredibly powerful is once you start seeing tokenized equities. Tokenized equities where you can then have that with the 24/7 rails with all the different things that we just talked about with the blockchain infrastructure. That's where there's going to be a massive, massive power of sort of the on-chain ecosystem.
Yeah, I think that makes sense. Yeah, that's all the questions I have for you guys today. I really appreciate your time. I hope everyone learned a lot, and yeah, round of applause for these folks.
session on stablecoins. Where did he go? Get back up here.
Apologies.
We almost lost our prize moderator.
You know, it was such a good time up there. I was just on my way out.
Yeah, you were excited. You were like, that's it, folks. That's all you got. Don't forget to tip your waitresses. Thank you, Cliff. Appreciate the chuckle. If it wasn't for you, I know what I'd do. Wither away. Well, Brandon, get back on stage.
Thank you.
Introduce the next panel. And then after this, we have a little bit of a break for everybody. Thank you.
All right, let's get to it. Next, we are going to be talking about stablecoins as the next settlement layer. I'm lucky to be joined by two people who are very knowledgeable on it and come from at very different angles and very different industries. So again, just to open things up, I want to give you both a chance to introduce yourself. Spencer, I'll kick off with you.
Hi everyone, I'm Spencer Jaffe. I'm at Circle. I manage our blockchain partnerships.
Hey there, Kyle Hauptmann, Chairman of National Credit Union Administration. That's a government agency. If you know what FDIC is for banks, it is the same thing for America's 4,000 credit unions.
Thank you very much. All right, I'm just going to get right into it. I know everyone's time here is valuable. Spencer, give us the bull case. What's going to make stablecoins the settlement layer rather than just a tool for payments?
It really comes down to institutional adoption and making sure that if you are a business, if you're, no matter what stage, you're a small business, you're a large business, you're a major enterprise, it really comes down to just like, do you still want to have this T+2, this T+2 settlement that happens currently? Do you still want to rely on more antiquated banking rails, on technology that frankly hasn't been updated in a very long time? We have an opportunity here to really disrupt the current ecosystem, the current world that we live in, and stablecoins are a very, very all-in-one solution to enable instant settlement, instant finality, and to provide just greater access of capital to a much wider range of individuals, both within this country and also internationally.
Yeah, Chairman, when you hear the name of this panel, stablecoins is the next settlement layer, do you hear a risk? Do you hear an upgrade? Both?
It'll be an upgrade if people want it to be an upgrade, right? There's no point in anybody trying these things out unless it's better, right? People can make their own decisions. By the way, when you say T+2, one thing about America that is even more antiquated, it's not the 2. That's 2 business days. You trade on Friday, 2 days later Sunday, right? Does that mean it settles on Sunday? No. It's 2 business days. We still use the phrase business days. As advanced as this country is, and I believe we have 18 of the 20 largest tech companies in the world, there are still 114 days this year. Every day I'm waiting for a tax refund I could really use right now, right? I keep saying, did it arrive today? Did it arrive today? Did it arrive today? There's 114 days that I don't have to bother checking because our government still only pays on certain days. And a lot of transactions like that. So that's even weird. So that's one aspect of upgrade. Is this thing working, by the way? It's going in and out, right? Okay, all right. Hopefully every day is a business day. All 24 hours a day are the same. We don't have ACH cutoffs. There are countries we give foreign aid to that already have this. So that's one thing I'm excited about. We don't have to have these strange calendar effects 24 hours. So that part will be an upgrade. The programmability seems to be an upgrade. I think it's starting already in credit unions. And normal transactions, nothing new, but just a new way to do it. If I can mention loan participations for a second, they're big in credit unions, small banks, which is, Spencer makes a big loan to Brandon, and I say, all right, my credit union will buy 10% participation. We don't actually buy the loan. I just go in, I'll take 10% of the cash flows, good or bad, right? This is a very normal thing. Well, every month right now is a problem stablecoins can solve. I have to ask every month, hey, did he pay you yet this month? And 2, when am I getting my piece? We should all be on the same chain. We all have the same information. All right, I'll use this. It's easier. All right, thank you. Anyway, a programmable money and a blockchain solves that, right? We all have the same information at the same time. And I don't have to trust anymore. And right? Because sometimes, like there's a late payment, well, you got to give your 10% of that too. Well, I don't know if it came in late. They often settle up on the 15th of the month, right? All these loan participations. And let's say after the 10th, it's late. Comes in on the 11th, it's a late fee. I don't know if I'm getting my 10%. I have no idea. I can't see this transaction. So that's what I mean by an upgrade, in that to start with, it's the same old stuff, just done in a more frictionless way.
Yeah, I think that's really interesting and definitely something I learned just now. I didn't realize that T+2 is not the world standard at the moment. I know crypto definitely upgrades that. But Spencer, I want to focus with, pitch this question to you. In terms of what can settle on chain today, what have been the latest advancements that have excited you, in terms of what can settle on chain today, as opposed to maybe a couple years ago?
I mean, I think it's just the assets that are available on chain today versus 2 years ago, 5 years ago. Back in the day, for those that remember, in 2016 when Coinbase kind of emerged and we're all excited about, oh, this is a speculative asset. It's no longer about speculation. It's about bringing a financial system that exists all around us today and moving it into a new venue. There is on-chain stock trading. There's on-chain derivatives. There's commodities like tokenized real estate, private equity, venture capital, so many different assets that are now available for anyone to be able to access, in certain ways and certain venues. And I just think that the possibilities are really limitless. Like, we were recreating the economy in the financial world in a venue that is faster, more frictionless, and frankly, less expensive than the one that is out there today. I think it just opens up so many opportunities. And we're still only just at the very beginning of that, because one day we'll see commodities markets are open 24/5 in the current world that we live in. That can be 24/7. All of a sudden, you have weekend ability, the ability to hedge on weekends against macro events. Stock trading is 9:30 in the morning till 4 p.m., Monday through Friday, off on holidays. All of a sudden, you have the ability to be 24/7 all the time. You can respond in real time to company news or events or things that happen. You're able to have much greater price discovery, which I think just creates a much more rich environment and an ability to, if we want a real open economy, this is just a great path forward.
With that said, so it sounds like we have a brave new world, right? A rich world of new assets, new markets coming on chain. Everything's seemingly available, at least where we sit, being entrenched in the industry. Chairman, I'm curious on your end, what do you think stands between today's market and institutional scale?
Well, government, us, right? Americans, we're the best in the world at monetizing innovation. I don't care if we invent it, we monetize it best, right? There's been three big in my life, in my opinion: internet itself, crypto, and AI. Crypto is different than the other two when it comes to politics, because it's very difficult for government to see the benefits themselves, because you don't really use it the same way. And by the way, myself, everybody else in the executive branch, I'm not allowed to own $1 single of a digital assets, okay? Not $1. Same with Treasury, SEC, et cetera. It doesn't even make the de minimis list. Office of Government Ethics has rules about conflict of interest, but they have a de minimis amount. You can work at the FAA and own up to 15 grand of American Airlines stock. No, I don't bother with any of this stuff. That sort of thing, right? I could own a small amount of a bank stock. They don't even allow that, a de minimis amount, nor can your spouse, nor can your children. So for years, when people went into the SEC and Treasury and said, these guys don't really get it, well, yeah, they don't. Neither they nor their children or their family have ever used this if they're following the rules. So that's one issue with government. But my point is, the government's used AI for years. They use it on tax returns. The NSA's used it for years. And I'm a Republican appointee, but I routinely credit the Clinton-Gore administration for one of the best things I think that's happened since I've been alive. 1997, principles for this new thing called the internet. You should go read it. It is a trip to read the language that they use. Number one, the government should lead. Okay? They put this on whitehouse.gov, a website that only existed for 2 years. Well, anyway, so that's the problem crypto has. You ask what the barrier is? It's that. And so when all you hear about is the negatives, because sure there's negatives, every new tech does. And every new tech is going to have major issues if it is widely adopted. Did you guys know there were 0 plane crashes before we had planes? Right. Not a one. When I was born, 0 internet viruses. You know why? We didn't have the internet. And so there's always problems, but the association with criminality, Hamas got 1% of its funding, crypto. Well, Hamas also uses cell phones. You think they're bad? They use laptops. You think those are bad? No, it's because that's all they knew, because you couldn't see the mainstream uses. Again, with AI and with the internet, when Clinton White House staffers were, oh my goodness, email, we don't have to use paper memos, like they could see it was useful. So the bad stuff with the internet or with AI, you didn't think AI bad, you didn't think internet bad, because you saw all the positives, okay? A plane crash doesn't mean planes are bad. It means a plane crash was bad. So that has been the biggest problem, and it's a shame, because this country, I think we agree, it's another industry we could dominate and get the most value. With all new tech, you're going to get the downside. Every country in the world has auto crashes every day, fatalities, but only a few have auto industries. Every country has ransomware and all that nasty stuff. Only a few countries have terrific paying jobs in cybersecurity and so you're going to get the negative. Our friends in Canada and Mexico, guess what? The economic displacement, I don't mean just like evil things like ransomware, but just economic displacement. Our friends in Mexico and Canada, guess what? They lost all their video rental jobs too. Nobody rewinding a tape in Guadalajara, right? But we lost those jobs, except what's the difference? Only our country is where you can work at Hulu headquarters and Netflix and be one of the early employees with life-changing wealth, or be the angel investor or the endowment fund that benefits. You're going to get the negative. See, what we're good at in this country is grabbing all the upside. So that's a long answer as to what the impediment is. And I would like to see government try to use stablecoins as quickly as possible for something, even internal government-to-government payments between agencies, because the more government uses the tool itself, the better off the industry is. And maybe even retail payments. Maybe I could get my tax refund 365 days a year. Imagine that. Or your mom's Social Security payment. It'd be terrific. And guess what? Someday we're going to have another March 2020. We're going to have another COVID. We're going to have a situation where it's an emergency. And we need to get a whole bunch of money very quickly and securely into somebody's hands. And in this country, 18 of the 20 largest tech companies in the world, you know what we did? There were 5 weeks of ACH. These are the stimulus payments. 5 weeks of ACH followed by paper checks, 40 million to old addresses. There were people who had not filed yet for 2019 or 2018. Paper checks. Remember, this was an emergency. This was feed the kids money, not get evicted money. The best we could do for 40 million people was paper checks to addresses that by definition were old, because there were people who hadn't filed the last 2 years. Anyway, the government itself needs to get to use this because it's useful, and that will have a downstream effect on how it treats the industry.
That is fascinating. I appreciate the thoughtful response there. I want to linger on it for a second, because you mentioned something that I didn't know, is that no one internally is allowed to even interact with anything blockchain related. I mean, digital assets.
Not $1.
Cannot own it. So that means, technically ownership is if it's in your MetaMask wallet. We just had a fireside chat up here about part of the mandate at the Fed was to integrate AI into your workflow. I think it's extremely important to, at least interact and use these platforms. Why is a crypto not one of these things? Like what's stopping?
Well, probably it wasn't at retail, right? Because the only ways normal people interact with it, either you own it, and that's the single biggest voting block, right? The last election found out there's not a huge voting block of crypto employees like with other industries, like farming employs a lot of people. That's a major political force, right? Manufacturing, et cetera. There's not a lot of employees, so that's usually a political voting block. But there were a lot of crypto owners, and they talked to each other, and some of whom are sort of one-issue voters about this thing. And there isn't an equivalent anti-crypto voice. Okay, even people don't like crypto, like it's not their thing the way it is for pro-crypto people. In terms of the ownership, that would have to be an ethics thing. I mean, I kind of get it in a way, but I can't even own an index with it in it. I could own, like if Circle wound up in the S&P 500, I own the S&P 500, okay, then fine, I could wind up owning Circle, but it's just, we just own index funds. That part I think is not important, but once the government starts using it, it will help when someday there's a disaster with stable coins. When a transaction fails, when God forbid one of these stable coins isn't stable, and there's going to be a sob story and it's real, the more the government's using it, the less they're going to blame the chain, crypto, stable coin. and they will then blame the particular situation. Because right now it's way too easy. Remember the association with criminality? I think it's still there. I testified last month and I got blasted about this because I suggested what I did to you, that the government use it. I still remember 2 years ago. We've come a long way. I wasn't chairman at the time, but we put out guidance modeled after the Clinton-Gore guidance on the internet. And member of Congress, are you going to use credit unions, use crypto, the thing that criminals use for illicit finance? I said, listen, if you think criminals often use crypto, you're going to freak out when you hear about cash.
Yeah, definitely. I totally agree. I feel like that conversation it causes a lot of sidetracking and sort of shifts conversations in a direction that's against progress. So I appreciate your position on that. Spencer, I want to flip it over to you. I want to talk stablecoins directly. And focus on the Genius Act. With the separation of yield through the new, sort of proposed Genius Act, from your perspective at Circle, what are the downstream effects of what's happened to yield in the Genius Act for the individual, but also as the issuer?
Well, as the issuer, it's there's a way to monetize stablecoins, and one of the ways is there's many ways to monetize stablecoins. One of the ways is the underlying yield. The fact that we are not able to do any pass-through to end users, obviously we can still function as a business. But I do think that, this is obviously views are my own, all that stuff. But I think that there's a huge value add to being able to interact with our end user in a way that, in the similar way that banks interact with the end user. And for us to be able to, to support them in that way, or to be able to work with a variety of new use cases or new users, it just unlocks a lot of opportunity. And so, we are able, Genius was an incredibly important bill, and that was the way that we can operate, and we know our jurisdictions, we know how we can be here in the United States. We also are using that as a way to say, can we use this as a framework to operate in other countries, in other jurisdictions? And so, Genius has been incredibly important. And, clarity to that point is also very important because it allows us to expand upon the use cases that we could potentially interact with and operate in.
Yeah, definitely. Chairman, you mentioned that the NCUA is exploring potential stablecoins for credit institutions, credit unions to leverage. Looking at through that lens, do you expect there to be a few national issuers, or is there going to be every single person, every single institution that has their own?
Just to clarify, I didn't decide to explore it. Congress ordered us to do rules by the Genius Act. The deadline is Saturday, and if you haven't noticed, we ain't going to make it, neither is anybody else. But however, in terms of going into effect, those restaurants where they won't seat you until the whole party's there? It doesn't matter at all if you're the second to last person, because you don't affect anything. Only the person who comes last actually affected the table. So my goal is just not to be that person. So we're not going to be the last one. That'll probably be the Fed. They still haven't put out. They haven't put out a single rule. Our rules, we've put everything out. The comment period ends. So we were supposed to have everything done, published, rule by July 18. We've at least got all our rules out. We have two. First one on how to apply to be an issuer is done and dusted. Good. Second one on the standards is out. Comment period ended. In theory, on Saturday, on the deadline, we could just say, okay, comment period's over, and then publish it the next day. But that means you didn't really read the comments. We'll have those. And by the way, just so you know, so July 18 was 1 year, right? Because it was July 18, 2025 when they passed it. Gave 1 year. They knew the mistakes from Dodd-Frank. That was 2010, 16 years later. A lot of rules still ain't written. They knew that having deadlines matter. The other one to have in your head is September 18. A lot of people aren't talking about that. The reason is because in order to pressure to get this done, knowing how agencies operate, they said 1 year to get the rules, but then January of 2027, January 18, it takes effect then, or 120 days after an agency publishes the final rule, okay? So if you do the math on that, if we, the regulatory agencies, want it to be our rules that actually govern the launch of this, it's September 18th, because it's the sooner of January or 120 days after we publish the rules. Therefore, Go back 120 days from January, you're in September. So that's kind of the other deadline to have in your head, because it takes effect with or without our rules, whichever comes first. And the only way it can be 120 days after our rules are published is to publish it in September. So I still don't know if everybody's going to make that deadline, but that's what's going on. And listen, it's not up to us what people do or don't do. The credit union subsidiary, it's called a CUSO, Credit Union Service Organization. They are the issuer. Whether they use, everybody does one, whether they all wind up sharing one, that's not really up to us nor our purview.
I appreciate that insight on that topic. It's sort of along the same lines, and maybe Spencer, you can lead this off, and both feel free to hop in. In regards to stablecoins, if you have basically every large institution end up issuing their own, what are the downstream effects of that? Is that just healthy competition, or is that a fragmented industry? Where do you see the future of that?
I mean, I think of it as I personally will see it as a fragmented industry. You know, would JP Morgan dollar really be able to interact with Bank of America? Like, probably not. You know, I think of it back in the 1800s, every bank actually had their own currency, and every state had different currencies, and sometimes there were multiple currencies in each state. And that was not a system that worked very well. I think that it is important to have kind of one or a handful of stablecoins that are able to be accepted by everyone and not have this kind of like quote unquote like war of stablecoins where you have, you know, JP Morgan launches a stablecoin, and then Bank of America launches a stablecoin, and then Societe Generale, and then all of a sudden you have all these different coins that are all technically backed by dollars, but also certain, you know, things may fall through the cracks. Who knows what can happen if there's so many different coins being launched at the same time? And I think it's hurtful to the industry, and it's hurtful to everyone if everyone tries to go at the problem like and do it the exact same thing. Everyone needs to come in and support different sides of the stack. And you know, there's issuers, there's also compliance components, there's also, you know, treasury components, and there's so many ways to interact and to be a part of the stablecoin flow that there's no need to have so many different kinds. And I think that it's important. There should be competition. Not to say that there should only be one stablecoin. I think there should be many stablecoins for many different use cases. But I think that if everyone launches their own stablecoin, you start to run into issues. And I'll also say, like, if people will launch stablecoins, and then all of a sudden you'll realize how challenging it is to actually manage a stablecoin. How much goes into the compliance of it? How much goes into sanctions? How much goes into issuance and record keeping and attestation forms and accounting? You know, it is a very all-encompassing effort, and if rates drop, it just becomes very, very infeasible for many. So,
good point on the rates. It's an extraordinarily interest rate sensitive business. We went a bunch of years. Japan went a lot of years with zero return on. There was 0% rates. I mean, even their 10-year was paying like 0.6. That's not enough to sustain a business. But interoperability, so from my standpoint, who or how many is not our business. But for this whole thing to work, there's only two things that I care about. One, the stablecoin has to be stable. That means 24 hours a day, not a moment's hesitation, because eventually it just becomes money. And it only does that, right? It used to be the Oklahoma dollar traded differently than the Texas dollar, and that was an issue. Interoperability, that could be all using the same one. Okay, that'll work, but regardless, because we're going to have transactions. And when they start failing, there's going to be backlash from that building right behind us, okay? A settlement of a mortgage where we settle on, you're going to sell my house for $500,000. We agree on that, and you come in with 500,000 USDC. And we're going to have like mixed marriages, right? Where one party walks away with US dollars. We have to be able to treat them the same. Do you ever go to Money 2020 or any of the big conventions in Vegas? But this is a very Vegas thing. But I was out there in October speaking to all these TradFi folks and it's at the Venetian, and I said, listen, everybody in that town, Vegas, already knows what a stablecoin is. That entire place was built on a settlement token. It's called a casino chip. And it doesn't matter if you gamble or not, what you think about it, that whole ecosystem, all those billion-dollar places, none of it works if there is a moment's hesitation that $100 chip is worth 124 hours a day, not a moment's hesitation. There should never be a moment where it trades at 99 cents. Okay, everything is built, including people's compensation that they take home. You know, the cocktail waitress when you tip, when she says, "Oh, I had a good shift. I got $600 in tips." What she has is 600 clay things with numbers on them. But she's right. It is $600. Why? Because she cashes them in anytime, anywhere. You know, the whole thing falls apart if there's any hesitation. Oh, I doubled down, won $100. Why do we say that? Why'd you say won $100? You're playing with these little clay things. Because it works, because it has trust. And they're stablecoin issuers. They use a settlement token. It doesn't have to be a stablecoin for a settlement token, but they use a settlement token for the same reason you use any, because it's easier than sitting there with cash bills all the time going back and forth. That's why you use a settlement token, but why is that settlement token? It has to be a stablecoin or none of it makes sense. There wouldn't be a Vegas Strip if there was any of that. And just like stablecoin issuers, there's two things that keep them in line. Market risk, your reputation. Right? If word gets out that, you know, Caesars couldn't pay out one night, that is terrible, right? That's awful for their reputation. And then they have their version of the Genius Act, government discipline. It's called the Nevada Gaming Commission, which is extraordinarily strict. If there's a chip out there, you got to pay it on the spot, no hesitation, or there's hell to pay, because none of it works without that. So how many stable coins? I don't care, not my business. I just care that these things flow, that when we do a transaction and I got to give you $500,000 and you come back at me next week with $200,000, it shouldn't make any difference that our contract is USDC or somebody else's, because it should just be money, right? The same way the waitress says, I got a tip of $5. She uses the word dollars. She doesn't say chip, because it's a synonym, and no one has any doubt of it. That's all we care about, because otherwise there's going to be major problems.
So yeah, just to like as you said, like trust is absolutely the most important thing, and like that I think is the key to all of this. Is, you know, no matter what, no matter if you're an issuer, if you're launching your own stablecoin, you need to have that ability to call back and say, at a moment's notice, I have $1 million on chain, I have $1 million in a bank account. Like, it doesn't work if you don't have that.
Wow. I'll be stealing that analogy. Just let you know now. That was, I never thought of it from that perspective. It also brings up this kind of in mind. You know, you mentioned trust. If all stablecoins are sort of backed, you know, by the US dollar, pegged to the US dollar as best they can, what are asset issuers really competing on? Or is this just a race to the bottom? How do you differentiate yourself as an asset issuer in the stablecoin world?
It comes down to trust and usability. Like, one of the things that we really pride ourselves on is our ability to always call back and say, if we have $74 billion on chain, which I believe is our current market cap, like, we have $74 billion in a bank account, and we can redeem every single one of those dollars whenever necessary. We also have interoperability. We have the ability to go not just across many different banks or institutions, but also amongst many different chains. And that's a big differentiator for us. Using our cross-chain transfer protocol, you can move your funds from Ethereum to Injective, or from Injective to Arbitrum, or from Arbitrum back to Injective. Whatever you want to do, you can move it instantaneously and for almost free, if not, like, I think we charge 1 BIP for our faster than finality transfers, but at regular finality, it's free. And so it's just a way for you to always be able to have your funds wherever you need them to be. And I think those are, like, that's a key differentiator for us. Obviously, like, we cater to a lot of DeFi, decentralized finance. We also cater to a lot of institutions. And so we try and really drive home key use cases and key value props for those audiences. Other stablecoins have other audiences, and they have the ability to really focus on those and optimize their flows there. But that's how we kind of see our differentiators. Those are two of the major ones, just that trust and interoperability.
Yeah, that, you know, brings up a good point there in terms of interoperability. Obviously, Circle launched USDC natively on Injective, but also it was the first multi-VM deployment of a stablecoin. Do you think sort of being able to operate in the multi-VM environment as a stablecoin, is that going to be required along with cross-chain interoperability go forward for stablecoins to become the settlement layer?
I think that there's one, like, Injective is far and away one of the most interesting and exciting blockchains that I've come across. I do a lot of research. I love all the chains that we work with, but, you know, something that's very unique about how Injective is built is this multi-VM structure. And so you capture a much larger audience, and you have greater usability across many different protocols, decentralized apps, you know, and just other players, other holders of assets in the ecosystem. And so it makes it a really unique deployment and something that we were really excited to be able to do this year. I think that the way that you guys have built the network is really remarkable, and there's so much usability. One, from like a just asset issuance perspective, like it's not just stable coins, of course, there's a million different types of opportunities that can exist on Injective and that do exist currently. And second, the fact that it's really built for finance. It's built to be a central limit order. It's built to help enable more trading activity so that users who are trying to build in or trying to work in finance or build in finance have a much more seamless place to do that. It's a really exciting opportunity. So we're really happy to be here.
Yeah, we're really happy to have you involved, and I appreciate that explanation for the crowd. I want to flip it back to banks, though. Get this question in while we still have time. I think it's really important for this conversation with stablecoins. Banks argue that stablecoins pull deposits off of regulated balance sheets. Pose that to both of you. What does that argument miss, or do you agree with it? Whoever would like to lead.
I think I would disagree with that. I think that it's the same thing as saying a dollar in a pocket pulls away bank deposits. Like I think that there's certain use cases that are important for stablecoins. There's certain use cases that are important for bank deposits. There's also certain use cases that are important for treasury bills or for stocks and for other more call it like riskier assets. Like I think that it's a challenge. It's challenging to kind of put a blanket statement out there. I would say that there's more utility that you get when you have something that is more liquid and more usable. I would say that banks would not like there to be, they want to have as many deposits as they can. They have the ability to lend out the deposits that they receive up to 100% of deposits, I believe, still. And so there's still a lot of, I think, there's a lot of advantage for them to be able to say, well, we want to maintain as many deposits as possible. And for us, we just say there's more usability when you have more optionality.
I appreciate that. Now, obviously, this is Injective Summit, sort of pro stablecoin, pro RWAs on chain. Do either of you see a coherent argument or lend any credence to the argument that is against stablecoin adoption, just to offer the contrarian view, I think, to the audience, or no?
I mean, the argument that I'd give against it is the U.S. financial system is not, I would argue that it's not broken. It still works. It still functions. We still have trillions of dollars flowing every single day. And for a lot of people, would say why fix what isn't broken? I would say that there's a lot of things that can be improved, and stablecoins and blockchain are a way to do that, and it's a way to really bolster that. But I understand when people say well, I actually don't mind waiting my 2 business days, which could end up being 3 actual or 5 actual days, depending on when you send it. And for them, maybe that's okay. In my mind, it's an optimization problem, and there's a lot that we can improve there. But I think that's an argument that I would maybe hear and say, okay, I get that.
I mentioned on the, so obviously I as an insurer care whether or not credit unions get in trouble, right? And at some point the US taxpayer should care. But it is possibly competition. There's a couple points I just want to make on that. I know you directed that to him. On this issue, banks losing deposits, okay? I just got a letter yesterday. It's addressed to myself and Comptroller of the Currency, Chair of the FDIC, and as well as the Fed, 4 agencies, okay? And if these new products begin attracting significant amount of deposits, public letter, by the way, I'm not betraying anyone's confidence. If these new products begin attracting significant amounts of deposits from depository institutions, we're concerned this flow of funds away from depository institutions means a decline in their ability to meet the credit needs of their communities. Oh, wait, my bad, I'm sorry. This is a letter from 1980 from the same institution about money market mutual funds. Sorry, my mistake. Here's the one from yesterday. Yield-bearing stablecoins risk diverting deposits to crypto firms, eroding the ability to meet the credit needs of their communities. So that's part of my answer. I'm being a little flip, but that's part of my answer. Also, I think people as often forget that there's this thing called other countries. 80% of current dollar stablecoins outside the United States. If a bunch of money flows into stablecoins, it's expected to be, a lot of it Asia, Africa, Latin America, some of whom have way more need than we do because we have easy access to dollars. When we think dollar stablecoins in America, we tend to think about the stablecoin part of it, that it's a useful settlement token, et cetera. Outside our borders, the dollar stablecoin phrase, the dollar part of it is the key part of it. To have access to a stable currency in some parts of the world, it is a life raft. It is tremendous for payments to not have to go in and out of their other currencies. And it is why 70% of the House and Senate voted for the Genius Act. That's the meta thing. It doesn't, even if you don't understand on-chain or coins or settlement tokens or any of that. What any member of Congress said, do you understand we have $40 trillion in debt? You know it costs a fortune. You know it drives up costs for everybody. It makes mortgages more expensive. Do you want to keep the US dollar the global reserve currency? If the answer is yes, support this bill, okay? You can't get 70% of Congress to agree on what day of the week it is. And they agreed to that. My point being, this money is supposed to go from all over the world to dollars, which means you park it in treasuries. That's why it was so important it went into treasuries. It's supposed to be a treasury buying machine from outside the United States. Trillions of dollars from around the world flowing into dollars, which means they park it into US treasuries, which makes our borrowing costs lower, which lowers interest rates, which lowers mortgage rates, allows us to do when we need them sanctions, because we can only do it because of the dollar network. No other country can do sanctions like we can. We do it because of the dollar. And once that's gone, none of us in our lifetime have had it where we weren't the reserve currency. Ask the British what it's like when it's gone. That's a very, very different life. And since World War II, it's been the US dollar, and the Genius Act was about that. So anything that disincentivizes holding stablecoins goes against that issue. It goes against the goal of keeping the dollar, the reserve currency. It raises interest rates because the Treasury has to work harder in its auctions to sell the debt. They're supposed to be Treasury buying machines. So, and why, so to the point of the deposit flight, per se, a lot of the money has nothing to do with the United States and has nothing to do with American deposit institutions. And by the way, the Genius Act only applies to US issuers. You're still going to find a yield-bearing dollar stablecoin. It's just not going to be one of the ones subject to the Genius Act. It's going to be from one of the other 195 countries in the world that already exist. So I do think it is a bit overstated. By the way, the one I read from 46 years ago, 1980, this letter from the same organization, back then their argument was they were trying to say that they, the banks, should be able to offer the same product. Back then, they couldn't offer money market funds. So that was a real problem. They weren't arguing to ban anybody from yield. They were saying, let us in on it too. Took an opposite approach last year, which is instead of saying, we want to be able to offer the same yield so we don't lose anybody, it was nobody can pay yield. It's just a different approach. It's interesting.
No, I think that's incredibly important. And you had me at lower mortgage rates.
So that does counterbalance. Let's say there is some deposit flight, okay? Let's say there is from America, even though most of the money's not going to be from America anyway, but let's say it does make it harder, okay? And it does, there's two other counter effects to that. One is, what they're going to say, the argument is, well, if we lose deposits, that means we're going to have to raise our lending rates because, you know, deposits are a cheap source of funding, and if we lose that, our lending rates for car loans and mortgages and stuff are going to go up. That's a fair argument. Okay, let's just say that some of that is true. Well, in that, what has also happened in that situation? That means stablecoins have taken off. That means the globe is buying treasuries. So you also have a force that is lowering rates, okay? I'm not here to say which effect is bigger. I'm saying that is a force against it. That's global treasury buying lowering rates. So your mortgage rate may not be lower, even if that institution lost some deposits and had to raise its rates in a secular sense, because you have that other purpose. Also, we might not need as much debt if we were all earning yield on our idle cash. There might be a little less demand for loan, right? If I earned $1,000 last year on all my idle cash over the course of the years, yeah, I still need a mortgage to buy a house, but I need $1,000 less debt to do it. So those are two other effects. So when you hear that argument about it's just going to make, we're not going to be able to offer you competitive loan rates, there are other effects going in the opposite direction to lower rates.
Yeah, no, definitely. We're coming up on time here. We got 60 seconds left, but I want to give you both an opportunity. 3 years from now, I just want one prediction out of each of you. What's a settlement actually run on?
what I care about is at least one U.S. government transaction running on those. It doesn't have to be retail like Social Security payments or tax refunds. I would like to see at least one transaction maybe to a foreign government or internal, because I think that's important, that the entities that regulate have firsthand usage of these things.
I just want to see 3 years from now that, you know, that stable coins and crypto in general are more well accepted in government. Like I know that, like it's different from the question, but I think that it's important to just be like that we can all align on like the fact that this is a objective improvement to our current system.
It'll just be money.
Exactly.
You won't say stable coins. The same way we used to say, I bought plane tickets on the internet. Now you say you just bought plane tickets. You probably bought them on the internet, but we don't have to say that anymore. I just sent some money, right? That's all it is. It's just transfer value. That's what I hope happens.
For sure.
Well, amazing. Thank you, Spencer. Thank you, Chair. Really, really appreciate your time. I hope everyone enjoyed it.
Welcome back, everybody. I'm here with Summer Mersinger. She's the CEO of the Blockchain Association. There's really nothing, I mean, we could talk about everything Clarity, and I'm sure we are actually probably going to do that, but there's no shortage of things to talk about when it comes to crypto policy. But let's start with Clarity.
Let's start with
Summer,
Clarity.
I mean, where are we with Clarity? It's probably a loaded question, so I'll narrow it down a little bit for you. I know you were here earlier. You had a great panel with my co-host Jacqueline. You left and went to the Hill, so you do have on the ground inside of actually like what is actually going on over there right now. So what have you learned in the last 4 hours since you've been gone?
Yeah, no, I mean, this is live. This is like live fire action here.
This is real time.
Yes, this is real time. I mean, they're getting close to on text. It sounds like most of the kind of issues that they were still working on in the Senate Agriculture part of the text, that they pretty much have that worked out. And they're just waiting to see what the ethics language might be. And part of that is going to come from an afternoon meeting. It should have concluded by now, but there was an afternoon meeting with Moreno and Lummis and the president and a few others where, you know, they were hoping to come out with some kind of, you know, language that everyone could get behind. And that's really kind of the last piece. That's the piece of the puzzle that we need. So
right. It's just ethics, really.
It's really just ethics, yeah.
Now, what I've read is that Democrats aren't actually involved in these discussions. It really is sort of being led by, you mentioned Lummis, you mentioned Moreno. We need Democratic buy-in for this bill. You need to get to 60 votes in the Senate. I mean, how is that possible if Democrats aren't involved in these discussions right now?
Well, I think what you have to remember is the Democrats and the Republicans have met on this issue for quite a while now, and they have been talking about it, exchanging language. So there is a framework there. And so part of this, you know, meeting, I think, was just to make sure that they weren't going to cause that this framework would be okay with the White House. So I think at the end of the day, you know, they're using the framework they had worked on it together from kind of previous drafts. I have not seen a draft of this, but from what I'm told, some of the previous drafts of the ethics language that they had been working, you know, across the aisle on.
Now that's the other thing. There has been no updated text, and the industry needs to see that in order to kind of understand what you guys are going to be signing off on, as it were, right? So when are you expecting text?
So I think in today's news, you know, one of the senators said it'll be tomorrow. My experience is if they say it's tomorrow, then it's the day after.
So Monday.
Yeah. Well, I think maybe this weekend we'll see text. I keep telling everyone, like, don't make big weekend plans because we'll be reading legislation.
Right.
So
this is the thing. Crypto never sleeps, right? So
no.
We're not closing up shop on a Monday and coming back on or a Friday and coming back on a Monday, right? You're working over the weekend.
We're working over the weekend. We've spent many sleepless nights going through bill text throughout this process, and we could be headed in that direction again. But, you know, it's critical to figure out what's in the bill, what's changed, and how it might impact impact our members. So it really is important that we look at the bill right away and go through that analysis process so we know what the bill does.
What is that process like? Just curious, like, do you scan it and then you kind of do a deeper read after that? Do you have teams of people on the bill where you go section by section? What does that look like at Blockchain Association?
So we're lean and mean. We've got a team of about 3 policy experts, and they kind of break it up. They use AI where they can, and that is one of the beautiful things about AI is it can look at 2 bills side by side and tell you the differences. Obviously, you have to go and double check that, but it's a good starting point. But they read every sentence, every piece of the text. A lot of times you have to go back to the original statute and compare it. So it's a very tedious process. But what the products we come out with is usually a chart kind of comparing and contrasting between previous versions, and then just an overall like top line, this is what section by section, what it does, what it means, and how it would impact our members.
What are you expecting on the change front? I know there's been some discussions around the BRCA. Do you expect any kind of significant changes to that language, at least from what we saw in the Senate Banking Committee version to now? Ethics, obviously, we talked about. That's sort of a separate issue, I feel like, at the moment. But in terms of BRCA, in terms of maybe Title III, maybe some of those other issues where Senate Ag was trying to hammer out some of those, niche issues. I can't remember off the top of my head exactly what they were. You said some of them were resolved, but what do you, high level, what are you expecting to see change-wise?
Yeah, I think the BRCA will remain intact. I definitely think the banking piece to this is probably not going to change when the bill comes out. They're still negotiating text in the Ag Committee, which is good. That tells me that they are committed to getting this done if they are still trying to work out language. And yeah, it's a lot of, kind of issues that, in some of our meetings yesterday, what the staff would say is these aren't policy issues necessarily. A lot of it's technical. How should this bill read? Sending it to the commission and saying, okay, are we doing what we want to do with this language? So they made it sound like it was they were down to technical, edits at this point. So I don't expect to see anything that's too different from, where the Senate Ag Committee was going into, I'm trying to remember which draft it was. There's been a lot of drafts.
I know.
Yeah, a lot of drafts. But, they had that bipartisan draft with a lot of the brackets. I think we're going to see something somewhat similar.
With brackets?
Hopefully not brackets.
With brackets,
yeah. That's what somebody said, is it going to come out with the ethics and brackets? And I was like, let's be done with the brackets. But I think there'll be some similarities there. Because that was a work in progress with the Democrats at the time.
Right.
But my hope is BRCA will be fine, that people recognize, went through the House, it doesn't, there aren't loopholes. This is a sound way of looking at DeFi, decentralized finance, and custody and control and all those kind of pieces of it. So I'm hopeful that it doesn't have any significant changes.
There's been an interesting debate around the BRCA because it is such a small piece of the bill, and you think about the broader part of Title III, which is, does give law enforcement a lot more tools, a lot more bandwidth to be able to go after these bad actors, these criminals. And, a couple of the law enforcement organizations have come out in support, a couple are neutral. I think the Sheriff's Association came out and they were pretty negative. I think it was pretty much a no-go. Basically saying crypto is for billionaires, it supports fraud, it's for cartels. I wonder where that disconnect is, where, the whole of the bill is, got to be a little bit better than the status quo, because right now there really is nothing, and protections are not as good under the status quo.
Yeah, I've gone into a lot of my meetings this week with member companies, and one of our member companies that when we talk about this, he makes the point that you want this technology developed in the U.S. because you can talk to that developer and you can find out what the technical, kind of aspects of it to help, kind of go after any kind of illicit actors. That's offshore, you're gonna, you're starting from behind. And so the idea of having this the software, the protocols developed in the U.S. is really an important part of making sure that it's not used for illicit activity. So, and to your point, status quo it's just not going to, it doesn't work.
Yeah.
And so this idea of the status quo is better than, having some disagreements around a few items of text. We're so far down the road. We're so close. And it would be a shame to see this fall because of, some kind of small issue in the text. So I do think people are recognizing that status quo won't last, that they're going to have to do something, and that this is a really good bill and has a lot of years behind it, a lot of stakeholder engagement.
Mm-hmm.
Members and their staff have worked so hard on this that I think people are recognizing, this is it. This is our bill.
I think everybody says nobody really realizes it's time until it's time.
Yeah.
Right? It's kind of like, it's a forcing function.
Yep.
We are now on Thursday of, I think there's about 3 weeks left, right,
Yep.
until the August recess. Is this really, is there still time?
Yeah.
Really? You think there's still time?
There's still time.
Okay.
Yep.
So it could go technically until the last week or the first week of August.
Yeah,
still a
certainly
possibility?
in the Senate.
Yeah.
It gets tricky when this goes back to the House.
Right. I think at this point, it's clear that there's not going to be a House vote
Well, and
before
the
the
House
August recess.
they leave a week earlier than the Senate.
Right.
So it does complicate things. But yeah, I think they recognize in the Senate, like the momentum is there and we need to do this now and we can't let it wait until they're back in September. So I do think everyone recognizes that, these next 3 weeks are critical, and the earlier you do it, the better. So I have a good feeling that there's going to be a vote, even as early as next week.
Because you said to me, or you didn't say it to me, but you said it on a Spaces, and I've brought this up to you before, but it stuck with me because you were in the small majority of people who were saying, I think this can get done after the August recess. Now it looks like part of the bill will have to get passed through the House after the August recess, so you were right. I mean, I've heard a couple people say lame duck session, potentially. We don't really know what the House makeup's going to look like after the midterms or even the Senate, truthfully, at this point. So, I mean, is this going to be something that we're looking at into 2027? Do you see it going out that far?
I hope not. I wouldn't give up hope if it does lead over into 2027, but I do feel like the momentum means we've got to do it now, and it just gets really complicated. You've got the August recess break, you've got elections. There's so many things that slow down that momentum. That this is kind of the moment to move on it. And I think people recognize too, going into elections, that they've got to do something. They have to stand. You got to stand for something at this point. Where are you on this issue? And I think it's really it's a good thing that the Senate will hopefully put this on the floor and make people say, are they going to be for regulatory framework for this industry, or are they for the status quo? And letting all of this activity move offshore again when we're in another administration that's hostile, or you get another Gary Gensler out there. So I do think it's really good that the people are going to be on the record going into the primaries, into the fall election, and crypto voters need to know where their senators are.
Got to get your take on Patrick Witt not stepping down, but taking a hiatus from his role at the White House, and he's become instrumental in these discussions, these negotiations, which you yourself have been a part of, stablecoin negotiations with the banks. Got to get your take on his time sort of winding down.
Yeah, we would not be this far without Patrick. He was a driving force that we needed from the White House, and so he will be greatly missed. I had just hoped that we could maybe get this done before he has to leave, but I don't think that's going to happen. But I think he's done a good job to have really being inclusive with his office, and so I think there are people who are prepared to kind of step up and fill that void. But yeah, as far as like giving, kind of pointing to one person, this has been all hands on deck. But man, Patrick really was like the glue here. He really was the driving force that got us to where we are today.
Yeah.
So it'll be sad to see him go.
A lot of changes. I mean, Senator Cynthia Lummis will be stepping down in January. A lot of the pro-crypto folks, I think Senator Steve Daines as well, kind of someone who's led on the tax policy front as well. I guess that'll be the next sort of frontier if Clarity passes, and if it doesn't, we could have a whole other discussion on Clarity, but we are running short on time. But Summer, thank you so much, and we'll see what happens.
Yeah, thanks for having me, and stay cool, because it's really hot out here.
You and I in the suit jackets,
You were smart to wear your sunglasses.
Thank you.
Thank you.
All right, welcome back to the Injective Summit. I am once again Gerald Gallagher, one of the co-hosts of Crypto in America. I'm here with Harry Jung from the White House, straight from the White House. Harry, how's it going?
Good. Well, thanks for having me on. And I think this was a due time that we finally collaborated after many years.
Yeah.
We've known each other in the private sector. Now, I'm in the government sector, but I appreciate the invite. Excited for how great the conference is going.
Yeah.
I've been trying to keep track. It's been a busy day today.
Yeah.
Welcome to have a nice discussion about the future of finance, tokenization, and all that.
Yeah, let's do it. Before we dive into that, so tell the audience a little bit more about like what your role is at the White House, like how you work on digital assets.
Sure, absolutely. So I've been in the White House Crypto Council. That's the easier term. We're officially the President's Council Advisor for Digital Assets. That's a mouthful. So I started, I think, in like May of last year. Obviously, our main priority is to ensure, to implement the President's priorities regarding all things crypto. That came into fruition through a couple executive orders early on in the administration. From there, it's no secret that, as widely reported, the big thing for us in our office right now is getting clarity done. And then, I'll go through a couple of accomplishments that this office as a whole has had throughout the last year and a half. So, everybody knows the makeup of the office. David Sachs, we collaborate greatly. His leadership and his guidance is always super helpful. Just from the way he sees things, and the whole ecosystem has been incredibly helpful. Obviously, Bo was in the office last year, as Bo and I, and then we have Patrick Witt, who's incredibly talented, and he's been great to work with. So people don't realize how small the crypto council is. You've been in with us a couple times, but it's Patrick and I, and obviously David and Tracy is a great chief of staff for us that really holds everything together. From there, last year we did the Genius Act, right? That was like a major step one.
Congratulations! 1 year.
Really, 1 year, right? I think literally this week.
I think so, yeah.
Right. But to get there was a hell of a journey.
Yeah.
And simultaneously, we were continuously working on the report as well. So, I'll go a little briefly into that, but, during the Genius process, also, we had market structure, trying to get that at the house.
Yeah.
And Bo, obviously, is super talented. We're able to navigate all those things on top of the report, which the presidential working group, pursuant to the executive order, a working group had to be created, comprised of multiple agencies, all the three-letter buffet of agencies, Treasury, Commerce, SEC, CFTC, and all that. We started meeting multiple times a week since January. And the executive order said 180 days, produce a report. It's basically the framework that the United States should take and what has recommendations to become the crypto capital of the world. So where are we now? Per those recommendations, a lot of those recommendations have been fulfilled already. Obviously, the big one is like the market structure one, and so we're literally working on that right now. But on page 141, if anybody's counting page numbers, it's 160.
It's a big report, man.
Yeah, it's 160 page. On page 141, there's a list of all the recommendations, and we really hope that even using that as it's like a university or somewhere in academia where, whether it's blockchain 101, crypto 101, someone could open that book and be like, wow, this is how the U.S. is so positioned, right, to even think about the genesis of how long crypto has come to where it is right now, and then what actions the U.S. can take and will take to become even a greater crypto capital of the world. As you and I know, that other jurisdictions started many years ago. And we were lucky to have the commander-in-chief at the White House who understands the importance of blockchain and this technology for the greater good of the economy, but also for the overall crypto ecosystem.
Yeah, what was it like? Because that report, I think, was such a big moment to get that out. I know Bo and I know Tyler over at Treasury talked about how many meetings between the two of them it took with industry, with other regulators, the alphabet soup of agencies you mentioned. What was it like just going through and then getting to that moment of all right, we had the deadline, we got the product out, here's what it looks like?
So, yeah, Bo and Tyler, I think the day one folks, right? Tyler's been an incredible partner to work with, and Tyler also, he has a whole team there that's fantastic. Andrew, Jonathan, Quinn, and all that. But yeah, they had a tremendous amount of meetings, and that sort of tells you and tells the industry that we all know that the innovation happens way faster in the private sector. So if policymakers who have to write a report on how to what position the U.S. needs to be on this innovative space, you have to talk to the people, and that's exactly what they did, right? Instead of I won't do too many comparisons, but in the prior admin, it was a pretty dark time, right? You ask for a meeting with regulators, you don't get a response.
Come in
back.
and register, right?
Yeah, come in and register, see what happens, right? Yeah. So it's not the surprise type of administration that we have. Yeah. So Bo and Tyler, incredible work that went in there, and that gave us the right intel and the intelligence at real time of what is currently happening in the ecosystem, and then that's why you can make those recommendations in the report.
Yeah. So I know we have limited time with you. I want to make sure we do talk about that future, the forward-looking on-chain future finance, and Clarity is obviously such a huge part of that. You guys have been working around the clock trying to get this across the finish line. Where are we now? How are you feeling?
Great, yeah, that's been priority number one for Patrick and I, and obviously Whitney and David and Tracy in the office. It is so essential for Clarity, right? It was a journey last year getting out of the house. Obviously, there's a ton of work went in. Obviously, once it came to the Senate side, and I think this year, getting out of 2 committees and Senate banking on a bipartisan basis, that was incredibly helpful. And right now, we're at the, I don't know, people give me different yard numbers. Let's
say 5, the 20, the 1.
Let's say we're in the 3-yard line. Let's say in the 2-yard line, and then right now it's the ultimate. I'm a Giants fan. I'm not a Phillies fan, but maybe like a tush push.
There you go.
We'll get that going. But this administration has a very good makeup of talented folks in the crypto space, and we're working hard and diligently.
Well, as the Jackson Dart and Scatabo of the Clarity Act, I know the industry is incredibly grateful for all the work you guys are doing. What's next on the agenda for you? What's getting you excited? Looking forward.
Pursuant to the recommendations and a lot of the things that the U.S. needs to do, obviously there's tax is critically important as well. There's also the ARMA bill, right? That sort of transformed from Senator Lummis to Rep. Begich. So those things are incredibly helpful for giving more, I'll use the word over and over again, more clarity in the crypto ecosystem once we get those down the line as well.
Yeah, incredibly exciting. I know we have a couple minutes more here. Just for my understanding, or maybe for our audience's understanding, tell us more about what that bill is that Senator Lummis is proposing. You call it ARMA?
It was. It's basically like the Bitcoin reserve. Right. Yeah. So, Lummis, and then Rep Reg, it was renamed the American Reserve Modernization Act, right? It's basically, how, on the custodial aspects for the U.S. government to retain Bitcoin and things like that. But, why is that important? I mean, I'm sure there's a lot of Bitcoin and OGs here, right? Like that was like the original. So having that, codified, it's incredibly important. We're like putting the U.S.'s position of how we think about it. As I mentioned before, other jurisdictions are not waiting.
Yeah.
Right?
Tell me a little bit more about that, because I think it's such an important point that keeps getting brought up over and over again. Is other jurisdictions are already moving, right?
Mm-hmm.
We've seen MiCA, we've seen a lot of responses. I think maybe the UK FCA is going to figure something out. What happens if America isn't able to get this done? Like, where do you see the innovation going?
So you never bet against the American entrepreneur and the American innovators. That's been true through the test of time and throughout history when any kind of innovative technology has emerged in any market, actually. So, everybody knows that the U.S. won the race to the internet, and I don't think that's going to be any different regarding crypto as well.
Yeah, super exciting times ahead. I think we'll let you get back to the hard work that we know you're doing, and thank you so much for coming on.
Awesome. Thank you.
Session of the day. We have the White House joining us just momentarily. Ashley, picture time later. Ladies and gentlemen, please take your seats. Come on, Anthony. I'm learning everybody's names. It's pretty impressive. What's yours? Hope. I hope everybody will take their seats soon for the final session of the day. We have Harry Chung, who is on the President's Council of Advisors for Digital Assets. He's going to be joined by Injective's Noah Axler to talk about the state of crypto. There was a meeting today, apparently, between the President and House officials on clarity, apparently, so maybe we'll dig into that as it hangs in the balance. Noah, do you want to take it away? Thank you.
Thanks, Frank. I'm Noah Axler, General Counsel of the Injective Foundation, and have the pleasure of introducing Harry Young, who's Deputy Director of the President's Council of Advisors on Digital Assets. Welcome, Harry.
Well, thank you for having me, and appreciate everybody sticking around for the last session.
Yeah, we've got 2 lawyers for the last session, so it's a bold move, but I think given where you are sitting these days, you have a lot to tell us. So let me ask you first, tell us a little bit about the Council and its mission.
Sure, absolutely. So where did it start? Obviously, the vision came from during the transition time as well. And actually, my colleague, Patrick, was down there during the transition, and there's an idea that how great would it be to create a dedicated office for crypto in the White House. Obviously, this industry has gone through a tremendous amount in the last couple of years, lack of regulatory clarity, enforcement, and such. But to have a point office within the White House where they could really quarterback issues, industries, and things like that would be incredibly helpful. So that's how it sort of the idea started. And from there, obviously, David Sachs, who we still work with greatly, and sort of the vision and the guidance that he provides is valuable. And then we had Bo Hines, who started as the first executive director early on, January 2025. I got involved with and I'll do a shorter name for our office because our name is like way too long. We just call us like the White House Crypto Council. It's like so much easier, better acronym too when we write emails. With my involvement in the CFTC prior to coming into the White House, so that sort of started with the pursuant to the executive order that the president signed early on January 2025. Was the order was to create a presidential working group, right, that involves a buffet of financial regulators to become, write the rules, what the framework is, create a report, 180 days to become the crypto capital of the world. And I was a representative from the CFTC, from the SEC. You might know, he's currently the chairman of the CFTC. He was the SEC representative. We have Tyler Williams and his team, which is fantastic, as a representative from Treasury, and then it was Bell. So we gathered multiple times a week since January, and we still meet till this day, actually in the same office. I talked to them way too much, but that's how committed this, we call it the PWG, has been the last year and a half. And what did we do? So there was a 180-day report that we did that was released in July of 2025. That basically was the roadmap for the United States to become the crypto capital of the world. If anybody's counting, on page 141, it starts like a list of recommendations that covers from capital markets, banking, payments, insurance, taxation, cyber, and even reshoring efforts to do that. So what the PWG does is to make sure that those recommendations are implemented. And on top of that, while we were creating the 180-day report, we obviously had to do Genius and also get clarity out of the House. So that was a super fun time. I started in like May-ish, so I've been here quite long. It was like me and Bo, and then now it's like me and Patrick. So seen it all, but it's been an incredible opportunity. And especially we have people don't realize how small the office is. It's like literally like David Sachs, Tracy, our chief of staff, that really glues everything together, and then Patrick and I on the crypto side. So that's been our journey, and I think it's no surprise that our number one priority right now, as of I just came here like 20 minutes ago, was all things market structure and clarity. So I'm sure you're going to ask these questions, but I know what you're going to ask, basically.
Yeah, we're going to get to clarity, but if you want to preempt me on that.
Yeah, it's we are full force, number one priority in our office to get clarity over the finish line out of the Senate. It was quite the journey. I think it's no surprise. I think everybody here is probably on crypto Twitter, that it's been widely reported of sort of the journey that has been since clarity came out of the House. A variety of things happened, but always on the Senate side, we had to get it out of two committees. Came out of the Ag Committee, came out of Senate Banking, bipartisan efforts there. So that was incredibly huge. And now we're trying to, we're counting. We're literally, I don't know if, I'm sure there's folks in here who've been to our office, but we have a calendar. We're literally like counting the hours and days when the Senate is in session. So like time is of the essence here. And people ask me like, what yard line do you think we are? Like, I don't know. But I'll tell you, like, is it like the 2-yard line, the 1-yard line? I'll do like 2-yard line, and I was talking to Gerald before. It was like, I'm a Giants fan, but it's like tush push time, to get it into the end zone. And then I think that'll be incredible for our country to get out of the Senate.
Do you have anything you can tell us from today's events that might be of interest on clarity?
What I'll say is that we are nonstop working. I'll tell you that. I mean, my voice is like gone by the end of the day, just like fielding calls, and Patrick's voice is gone. So literally we sit across from each other all day just talking about this. So, but I'll just say that.
Fair enough. Would you be willing to share with us what you think the final hurdles are in getting clarity across?
Well, it's continuing to stay engaged with industry folks, and obviously working. We are talking to our side of the aisle and the Democrats as well, right? I mean, you saw that from sort of the fruits of the labor coming out of the Senate Banking Committee. It came out bipartisan, but it's always, that's not an easy thing, especially regarding crypto, especially where crypto has been. But I think that was a testament to how much effort that we put in, but also as the other side, and keeping those lines of communications open. It's incredible to me that how crypto and tokenization and blockchain became like a battle in the prior years of like a good and evil thing, which is like crazy to me. It's like technology, and like I'm pretty new to. I always say this, and then I feel a little. How do I say this? I'm new to government, so I'm new to a lot of the processes over that building right there. So I'm always asking folks like on the Hill, like what is the process? You know, like, you know, because I'm learning. I'm coming from more of like a industry side. That's where I came from. It's just like is with the mindset of is what we're writing on text and things like that, is that actually implementable? Because like as a business person, as somebody that's like on the private sector, okay, you got these rules and laws coming down, but like if they don't make sense from a business standpoint, and it's not, you can't actually implement them. Like, what is the purpose? So hopefully that was sort of like, I could be like that value add. You know, we've had great engagement with folks in the industry as well, because at the end of the day, the innovation happens way faster in the private sector. So as policymakers, we have to stay engaged. We've heard stories where, in the prior years, where you can ask for a meeting with a regulator, you don't hear back. Like our policy, you know, and obviously, you know, with David's been a titan in the private sector space. Like, all right, let's talk. Like, what I always ask the question, like, what are exciting projects that you guys are working on? And then the stuff we hear, are like, wow, it always amazes me. There's so much potential, and there's continued growth. You know, blockchain is an incredible technology. There's so many use cases. I mean, we're so caught up in the financial regulatory space, but I always say, like, that's only like one slice of the potential that blockchain has. There's the amount of commercial use cases that's out there, that's happening right now, and that more is gonna come to it. That's really exciting for me.
Let me ask you, because you touched on it. You were previously at the CFTC, and before that, you were in private industry. Can you talk a little bit about how your background, you know, sort of influenced your views on crypto and your new entree into regulatory work?
Yeah, I'm exhausted from like the word like market structure and clarity, because like I still remember like when like Fit 21 was happening. Like just a couple, and then in crypto years, like 1 year is like sort of like dog years. So like you just like exit by whatever. But like market structure, this topic has been around for a long time. I still remember that. And I was at Citigroup before I came into government, like 2.5 years ago. And at that time, folks were exploring like what I think the first questions even from regulators. So this is like back in like 2021. Was like, what is Bitcoin? What is DLT? And you could really like age yourself. I know exactly what period of like this ecosystem folks went into when they talk about like DLT versus like blockchain. I'm like, oh, you know, you refer to as DLT. Yeah, you're probably from like that era, right? So it has evolved, but I went through that the very like exploratory stage at a bank at that time, where it was like, you know, you didn't have the right regulatory rules at that time. You didn't have the administration that was really helping you. So that's why it was pretty difficult to like really talk to board members, executives, like why this is important, right? But if I look back, you know, you work at a bank, and then, you know, they do tons of payments, all these pipes and plumbing. Like, all right, here's this technology that makes it like way superior and way more efficient and way faster. But ultimately, you know, it took years, especially in Congress, here, you know, everywhere on the educational piece, and this industry has come a long way. So I've seen that, like, history, and to where we are today, it's incredibly refreshing. And as we even work through market structure, like, we talk to congressmen, senators, and a lot of them get it. But ultimately, like, the person who does get it is like the president, right? Ultimately our boss. And, you know, he made a campaign promises on, like, you know, crypto is an incredible technology. The POTUS always truths about it too. There's a reason for that. He understands the importance for the U.S. to become the leader in this, and we will become the leader. And we already have the companies here that are already leading. And it, you know, other jurisdictions are not waiting, and they have not waited. There's like, I won't name specific jurisdictions, but they've already had their frameworks for years. But the beauty of us in the U.S. is we can be malleable, right? We'll put more thought to it, and then you never bet against the American entrepreneur.
Well said. Well, I think we've grilled you enough on clarity. Let's turn to Genius for a second. Obviously, the industry welcomed the passage of Genius. We've talked about it a lot today. What's left to do on Genius, in your view?
So the Treasury team has been incredibly busy. Obviously, even until this week. Where I see Genius is, you know, there's a reason why we were able to get that done, how important it was for our economy, the U.S. dollar, right? U.S. dollar-backed stablecoins, economic security is national security. I truly believe that. You've heard that from, Secretary Besson, other folks in the admin. And the way I see this whole like U.S. dollar-backed stable economy, it's already like, if you look at some numbers, I mean, there's a bunch of numbers out there. It really made like a hockey stick on a volume perspective once Genius passed. Why is that? Because it brought more clarity, right? There's like legitimized, right? There's rules of like how issuers and registrations and oversight and things like that. So I think it's just really the start still of like how much adoption from an institutional basis that goes. And at the end of the day, people say like, oh, there's like the crypto space, like TradFi, crypto. I'm like, it's all just going to be fi. We're all just going to be like at a certain period in a certain year, everything's just being normalized, right? I always use this example, like especially just observing my like young kids, right, like 7 and 3 years old. Like I did this. I use this analogy because it's like it like sort of like took me back, because when when folks, and I don't know how old everybody is, but like when you say like, oh, I'll give you a call, right? You do this, right? This is a phone, everybody. But my daughter's like, what is that? What is this? So she's like, I'm like, that's not a phone, Daddy. I'm like, yes, it is. She's like, a phone is this. So her whole life, that became the BAU thing, right? That's how I envision like the future, where like it's just like, oh, I'm transacting. It's like super fast. Great, that is the norm, right? I don't have to wait a couple days. That's the norm. So that's like the future like outlook ecosystem that I hope that like my kids don't have to wait for, or write paper checks and things like that in the future.
No, understood. I think we're all working toward that goal. So we've covered Clarity, we've covered Genius a bit. Is there any other legislation or issues that are on your radar screen?
Yeah, so as I mentioned, Genius is critically important. We're currently working on Clarity. There's also tax is critically important as well, right? Like, so for like folks to, a big thing was also in the report is like how do we onshore companies that had to leave? Like a lot of these foundations and so forth had to leave because the environment wasn't there. Well, first, regulatory uncertainty, a very enforcement-friendly administration / regulatory financial regulators. So like, that's why they left, right? We want folks to come back home, right? But how do we do that? We need to set the regulatory parameters and the ecosystem to do that. But there's also tax implications, right? For businesses to establish themselves in our country. So that's a tax, obviously that's making its way. And then there's also like the Bitcoin Reserve, and now it was sort of rebranded by Rep. Begich, called the ARMA bill, the American Reserve Modernization Act. So that's also exciting to see. But there's plenty of things also in the banking and payment section, the insurance areas. There's also a whole cyber section that we're working collaboratively with Commerce and the NIST that's under Commerce, which is like the cyber experts, on sort of we don't want to create new rules or new standards for no reason, just for a specific industry, but like observations. So they should be coming out with that report sometime, hopefully in like the next couple of weeks.
Great. Well, we'll look forward to seeing that. Let's talk about tax for a second, and I think maybe there are two issues, right? There's giving guidance to new companies that are coming into creation, but there's also the existing crypto ecosystems that have a significant interest and I think would like to move back to the U.S., but they may face tax hurdles in doing so, and I assume that's part of what you're looking at.
Yeah, what I'll say for that, I won't give too much like tax advice. I'm not a tax person, but at a big picture level, is engage with the regulators accordingly and the government, right? It's like if you're seeing stuff, if you're seeing hurdles or challenges, like you guys are living it every day, right? You guys have a balance sheet, you guys have clients, so you guys see the numbers every day. So like, but what can the U.S. government do to make that better, right? Mm-hmm. And that makes informed decision making.
Yeah, I agree. Well, thanks for at least weighing in a bit on the tax issues. Last year at our summit, that Summer Mersinger predicted that the first U.S. perpetuals futures product would be approved. That's happened. Do you have a view on how the perps market in the U.S. may develop?
Ooh, that's a great question. I'll leave that to Chairman Seelig and things like that. in that world, I mean, we are aware of that, but obviously there was a lot of activity offshore, right? That was no surprise. And I guess the baseline comment that I'll make on that is any type of innovative trading strategy or mechanism and so forth, volumes are very important for transparency for the rest of the market. So I think that's critically helpful. But on that kind of stuff, I'll leave it to Mike because he's very good.
Understood. I take it then, although it goes a little bit beyond crypto, prediction markets are obviously a hot topic that might fall in that same bucket. Are you all looking at any issues related to the prediction markets now?
I've been focused on clarity. To tell you the truth, I don't know what the algorithm is on my Twitter feed, but I'll see all things that are happening. Obviously, during my CFTC time, which was a sort of crossover from the prior admin to the new admin, there was a lot of buzz there, and obviously with the CFTC doing a lot of stuff there, I've been looking at it from a distance, but definitely there's a lot happening there.
Yeah, we understand, of course, that clarity is taking up probably all of your time right now. Maybe just to return to it for a second, we've talked about it a little bit today, but do you have any sense of a timeline on when we might get a vote?
Well, ultimately, we're as I mentioned, we're literally counting the days. I think the Senate's in session for only till like the first week of August. So, that's we would ideally like to get it out of the Senate before recess. So it is no surprise that we are working hard to get that done.
Yeah, we know and appreciate that. So we'll continue to follow your efforts. You touched early on in our conversation about the reporting and recommendation function of the council. Is there anything we haven't covered that any recommendations that we haven't covered that you think are important to mention?
Yeah. So what I've realized was because there's been so much focus on the financial regulatory space of things and the recommendations in the report it covers most of that area, but I welcome folks in the crypto/blockchain ecosystem that are doing stuff outside of that too. We've had a good amount of engagement, but I think I would appreciate more on the commercial use cases. And I love connecting folks to you're doing exciting stuff about tracing data of fish on the chain to know will I know if my bluefin tuna is from this XYZ location? That's perfect for blockchain, right? Supply chain management, that's perfect. And we have folks, our point person that does blockchain, crypto, commerce or treasury. I love having those collaborative interagency and private sector meetings because it's always a nice break from talking about the same topic over and over again. And we have a open door policy, especially in the White House Crypto Council, to talk about those fun, exciting projects.
Yeah, that was one of my questions for you. How do industry participants reach out to you? How do they engage with the council?
Yeah, you have to write a hand mail. No, you don't have to just email us. I think that a lot of folks in the room know how to connect with us. If not, then I'm always open to take a meeting. A little crazy the next couple of days or weeks, but it's weird. I hear stories where thank you for responding so fast to me or getting back to us. I'm like, sure. That's it's normal, right? In the private sector, you don't respond to your boss, you're fired. So, but it's crazy to see that observation of appreciating government officials responding back to you, because I think we're public servants, right? And we are really believe and dedicated in blockchain technology and crypto and so forth. So come talk to us.
Can you share, and I think you did a little bit, some of the things you picked up from the industry meetings that maybe have influenced your approach on the council?
What has been helpful, especially for industry, is where they have business operations in other jurisdictions as well. Because it's really hard to, keep track of everything that's going on globally. But if someone comes out hey, this is our secret sauce and our business model. We operate in XYZ jurisdictions. And I always ask, what are you seeing? The industry is really our eyes and ears on the ground as well, real-time updates. That helps us too, while we think about policy. So that's been very helpful. That's why I say, email us, come talk to us. we're happy to talk.
Yeah, I mean, that's an interesting issue. Assuming and very hopefully we get clarity passed soon, is there any thinking that maybe meetings with foreign regulators might be of use?
Well, that's a great question. We have, finance ministers, foreign ministers, are sort of our counterparts at other jurisdictions come and meet with us too. And actually, what did they ask? They're waiting to see what we are going to do. Whether it was, this stems from even early on in the part of the administration. They're so curious what the U.S. is going to do because the U.S. has always led in any type of like financial regulation or innovative regulation historically. So, they are, especially right now, they're waiting to see what we're going to do, the progress. We live in a great era where there's like free access to information on the internet, but it's no surprise that everybody else is watching what the U.S. will do in this space.
Yeah, that's been our sense as well. I mean, it may be obvious, but can you talk a little bit about the path if we don't sort of get our act together? And
I'm a glass half full guy all the time. It's like not that hot out, right, guys? I will make sure that I'll say what's in my instincts is we will work as hard as we can to get clarity over the line.
Appreciate it, and we're remaining optimistic as well. Can you talk a little bit, I mean, clarity obviously is dominating our conversation and dominating your time, but can you tell us anything about the future of the council and what it might look like 6 months down the road?
Well, I think again, glass half full guy. I think we'll be super, super happy. Things are passed. The regulators are writing their rules. There are more use cases, popping up in the U.S. More firms are coming onshore. We have more regulatory frameworks in place, and then we consistently keep winning. I'm a big fan of winning, so like and being positive moves. So that's what I expect 6 months later.
I think that's a great thing to be a fan of. So might be safe to say tax issues might take a fair amount of your time if we get clarity where it needs to be. You've mentioned a few other things. Let's take it out a little further and maybe not just limit it to the council, but where do you see crypto in 2 years in the United States? What does the industry look like?
I think in 2 years, I mean, there's already been like tremendous amount of institutional adoption. When there's like, I feel like this is the same playbook when there's like new technology, that the institutional adoption happens like way faster, and then that trickles down to like the consumer and things like that. Crypto's interesting because they like sort of like did the whole like reverse, like the, like the retail consumer, like peer-to-peer, like from the genesis, like from there. That's like sort of the roots of the merit of blockchain, but institutions have been moving and will move even faster with regulatory clarity, and then that's just going to grow, and then more businesses and more types of asset classes and trading strategies will happen. That's what I expect to see and I do want to see.
How big a component of that development, at least on the maybe retail side, not just retail but institutional, is education?
Education is key. I'll do another plug for why clarity is so important, because it provides the consumer protections needed, right, for this ecosystem to operate properly within the United States, right? It's like, okay, like clearly define what's the security, what's the commodity. Okay, you want to do XYZ activity? All right, get your registrations, right? There's protecting developers. There's BSA, AML, and all that. Like literally, it's interesting to me because we're obviously Republican administration. We want the rules, like we want regulation. The industry has been asking for regulation. Please regulate us. Please give us the guidelines, right? Like I think that's very unique to the whole crypto ecosystem, and we are doing our best to make sure that happens.
Understood. Well, you touched on this as well. How important is it, and I think we see this in Clarity, we certainly saw it on Genius, how important is it for crypto to remain a bipartisan issue?
I mean, I don't think crypto is we should take politics out of crypto, like Totally, right? It is a technology, right? Like, I'm sorry, if you're like allergic to the internet, like you should just like stop, right? So it's, as I said, it's wild to me that it became like this whole like battle of like good and evil, right? Yeah, I people ask me all the time, like, it's a bipartisan. I'm like, well, like, why is that? I'm fairly new to like this whole government and like political thing, but it's like just use some common sense here, and then it gets pretty far, I realized, in the whole DC world.
Well, it certainly seems like clarity, and we've heard a lot of optimism about its passage today as a good, sort of test and an example of bipartisan work that arrives in the right place with crypto, not to mention many other things in Washington. But we certainly appreciate you joining us. Any last thoughts you want to share, either personally or from the council, that we should be aware of and thinking about in the industry?
Yeah, no, well, I appreciate everyone making the time at the end of the day. I had to change up the schedule a couple times here. But, I think it's incredible that we have folks gathering. I think I go back to like a couple of years ago where there was like first conferences at like a law firm conference room in the corner in like New York. And now you have, full-blown conferences where the OG crypto people, I see a couple OG people here, shout out to Gerald over there, he's one of the OG guys, where it's become a very mainstream and important thing, and it also is hit top news. There's a reason for that, because this ecosystem has grown. There's, the importance of it in DC, the education piece has been said, so it's now time for us to shine. And then, folks who are, operating in other jurisdictions and things like that, thinking about coming back to the U.S., obviously we welcome that, and we welcome the engagement anytime. Just send us an email. We're happy to chat. Appreciate everyone's time today.
We appreciate yours, Harry, and your efforts on behalf of the industry. Thank you for being with us.
Thank you. Appreciate it.
Great job. Thank you. Amazing. All right. The jackets come off, which indicates that drinks are on the horizon. Getting ready. It's like a wedding, By the end of this, maybe my tie might be on the head, I don't know what type of weddings you go to, but those are usually what happen at the ones I go to. But before we dive into the happy hour networking session, we just want to show you guys an interesting testimonial from Injective and their partners on how they're building the future settlement network for what will be the future of global finance. Thank you so much for taking the time. Thanks for joining us here today. Appreciate you. Thank you. Thank you.
When you're sitting in a large bank or a large hedge fund, time is quite literally money.
Right now with TradFi and traditional securities, you have Saturday, Sunday, potentially Monday, Tuesday, where you have a 96-hour margin period of risk.
In traditional finance, the settlement takes a very, very long time. What blockchain allows us to do is settle within seconds or minutes.
Injective is the first blockchain purpose-built for finance, where users, institutions, and even AI agents can transact, tokenize, settle, and trade all in one place at scale.
Injective has been able to really optimize their performance. They have one of the fastest settling chains in the blockchain space.
One of the biggest reasons we love Injective is that developers are moving to build things on it. They like it because of its speed, because of its security.
What Injective is doing is really, really cool because they're creating virtually limitless optionality. So you don't have to wait for somebody else to build it. You can actually build it yourself.
It's really taken a long time for on-chain markets to get to the scale that Wall Street is paying attention. And a lot of that transition has happened in the last year or two.
You're seeing trillion-dollar asset managers begin to put assets on chain. 5 years from now, I think a lot of the traditional equity markets are going to be gone. It's all going to be on chain.
Artificial intelligence is obviously being adopted at a rate that is unprecedented. We're at the kind of cusp of agents making financial decisions. They'll be able to transact much faster, and they will use crypto rails in order to do that.
What we've been doing is allowing AI agent developers to fully utilize the Injective blockchain.
Injective is leading the charge for creating a truly global unified market for all assets.
Finance is moving on chain, and Injective is where it settles.